Live streaming is on.
Okay, 1 minute so that we wait for Paolo to join us and we start.
So ready, steady, go?
Yes.
Okay. Thanks. And dear participants, here and online, good afternoon. Welcome to the Crypto Asset Lab conference at the University of Milan Bicocca. It is my honor and pleasure to open this third edition of a conference that, since the inception of the lab, brings together academic, practitioners, policymakers, and regulators to discuss, share opinions, contribute to the achievement and advancement of our knowledge of this continuously changing and evolving world of cryptos. The University of Milan Bicocca is a young university for Italian standards. In a way, you can consider us as a teenager university with only 22 years of seniority. But in this lies our strength, the willingness to be at the frontier of research. And there is no doubt that crypto assets are at the forefront of investment opportunities, fintech innovation, and regulatory challenges as well. You will experience all these through our diverse streams of presentations dedicated to the different aspects of crypto assets, economic and quantitative modeling issues this afternoon, investment and trading aspects, regulatory and legal issues tomorrow, and a specific and special session dedicated to fungible and non-fungible tokens. It is a novelty of this year conference. In fact, in only 3 editions, we have grown in the number of papers submitted, subject of investigation proposed, number of participants from all over the world, but also thanks to the technology that helps to connect us. I was allowed to, to leave this, and otherwise it is difficult to hear me. So last year's conference was held entirely online. This year we are experiencing a new normal with a hybrid solution, in person and online. I think that this solution will remain the future when I will be sure that we can say that the pandemic is over. So we will be able to bring together scholars from around the world to discuss their preferred topics, but at the same time limiting the environmental impact. It is something that we have learned to do and that I think it will remain in the future. But it is time to start our conference, and let me introduce Ferdinando Metrano, the director of the lab and a great organizer of this conference. Then we will have Lucia Alessi from the JRC of the Economic Commission, our co-organizer of the conference, and Massimo De Rosa from the Regional Council of Lombardy. Thank you, and Ferdinando, the floor is yours.
Thank you, Paolo, for the introduction, and welcome to everybody, again, both in presence and remote. This third edition is, let's say, ahead of a huge achievement. The first one was a very local one, just between the Digital Gold Institute that I did found a few months before and the University of Milano Bicocca, because this is when Crypto Asset Lab started, basically from this joint venture. And the history has been about increasing the footprint of the conference, mostly thank you to the European Commission and the Joint Research Center of the European Commission. And so now we are expanding. The topic It's relevant, all relevant. I mean, everybody reading just the news, you do know that crypto assets are on fire. And in a way, this also validates the original choice. We have never been playing too much with blockchain-y stuff or blockchain technology. We have been very much focused since the beginning on crypto asset. And what we are discovering nowadays that crypto asset is what is relevant, especially in consideration of the lack of general purpose blockchain technology application. So count me in among those of you looking forward to many interesting presentations today and tomorrow, and I will leave the floor to Lucia Alessi from the European Commission.
Thank you very much, Ferdinand. A warm welcome also from my side. My name is Michele, indeed, and I represent the Joint Research Center of the European Commission, which is the science and knowledge arm of the Commission. Our job is to provide technical support and scientific evidence for the development of the policies of the Union. And because of the nature of our mission, which is essentially doing science for policy, we are particularly happy to co-organize the Crypto Asset Lab conference also this year, as several of the papers that will be presented have clear policy implications. Let me give you just a very brief example of the policy relevant science that we are after with reference to crypto assets. A problem that we are all aware of is that new alternative means of payment and investment threaten to undermine the progress made on tax transparency, as the use of cryptocurrencies such as Bitcoin facilitates tax fraud and evasion. And against this background, the European Commission will amend the directive on administrative cooperation to ensure that EU rules include other areas such as crypto assets and e-money. Essentially, the Commission needs to tackle the lack of information at the level of national tax administrations about the emergent use of crypto assets and e-money, which may possibly result in revenue losses also for the EU budget. The JRC contributes to the impact assessment of this legislative proposal by shedding light on the taxation of capital gains from cryptocurrencies in the EU, providing a first approximation of the quantitative importance of capital gains from Bitcoin. In particular, a recent JRC paper, which is available on the JRC website, estimates that Bitcoin capital gains in the EU could be around 13 billion euros in 2020, including 3.6 billion euros of realized gains. And applying national tax rules on capital gains from shares to those from Bitcoin yields a simulated tax revenue of about 850 million in 2020. But if you consider that the Bitcoin price is now about 6 times higher compared to 2020, the potential tax revenue is in the order of some billions. So CAL2021 will provide further policy-relevant scientific evidence on all aspects of Bitcoin and crypto assets. Hence, I would like to extend a huge thank you to Ferdinando, to the University of Milano Bicocca, and to all the speakers for supporting the European policy-making process with your research. Thank you and enjoy the conference.
Massimo De Rosa from the Lombardy region, whose patronage we are enjoying, please.
Good morning, thanks for the invitation. It's a source of great pride to be here today and open the works of this conference, and I thank Professor Ametrano and you all for this opportunity. I approached the world of cryptocurrencies sensing the unlimited possibilities of a universe that is often still perceived as very distant from us. This is why I embarked on a path made up of meetings and debates, starting last July from the academic world and then moving on with companies and financial operators. The first step was the approval of an act signed by myself, which commits Lombardy region, on whose territory some of the Italian excellencies in the sector already work, to becoming one of the first European players in the crypto field. How do we do this? By promoting initiatives aimed at networking between companies and at the development of the collective knowledge of this reality, and by working, in agreement with the government, to regulate the sector in the interests of companies, investors, and sellers. Lombardy region was receptive to our suggestion and accepted my invitation, sponsoring this conference. Now, my next step is the creation of a regional working group, in which the major players in cryptocurrency work together with the institutions to create a network and develop a district capable of retaining the excellencies of the sector already present in the area, encouraging research and creating work, to inform the population and institutions in order to bring them closer to the opportunities of this sector with the appropriate tools and protection. Thanks again for the invitation and good luck.
So thank you everybody, and we are sharp on time, actually some minutes ahead, and I would ask if Marco Petracco is online to be connected, because he will be moderating the next session.
Hello?
Yes, Marco, do we hear you? Do you hear us?
Yes, I can hear you. Can you also see me?
Okay, now we also see you. Thank you, Marco. I know you had a personal misadventure this morning in trying to reach Milan.
Yeah.
I'm sorry, but thank you for joining us nonetheless. And I will leave the floor to you for what is the first session, Cryptoeconomics, number 1, because there will be a second session on cryptoeconomics. We have 4 papers, and I'll leave the floor to you, and I urge all the presenters to turn on their webcam and microphones, okay? The floor is yours, Marco.
Thank you. Thank you, Ferdinando. So, as Ferdinando said, welcome to the first cryptoeconomic stream of the Crypto Assets Lab 2021 conference. Before moving on to giving the floor to presenters, I would like to mention to give some thanks to our co-organizers, University of Milano Bicocca and Digital Goal Institute. And I would mention also our goal sponsors, Deloitte and CheckSig, and our silver sponsor, Relidata. I remind all participants that we have a rather strict 15-minute time limit, followed by 5 minutes discussion for the papers in this section. So, given the tight timeline, without further ado, I will give the floor to the first of our presenters, Jiang.
Hello, everybody. Let me share my slides. Share.
Janet, we don't hear you that well.
Yeah. Oh, you don't? So,
okay,
is it
now
better?
we hear you better.
I can hold the mic a little bit closer to myself.
Okay.
Share content.
Yeah, now we also see you. Fantastic.
Yeah. How come the share is, let's see, the share is, I click on the share button and share, I think my share button is not active, I would think. You need to give me the right to share it, I think.
Let's provide to Janet the right to share, please.
Yeah.
Don't worry, Janet, you're just the first one, so of course the technical glitches are on you in a way, but we are 5 minutes ahead. So
no, yeah, that's good.
So it won't cut in your time.
No, that's fine. I think should be good. As you can see that my share is not activated, not that I'm technically clumsy. Okay.
Because I am not able to activate the share of participants. can't apparently. So
You cannot. I think
that
somebody
will
else
When
want to.
when I do the test with Lucia, she told
It was
me
fine. Yeah.
that the red arrow now is in
Oh yeah,
U4
the red arrow
unit.
is yeah, Unimip. We should change it to me. I think that red arrow on the panelist list, that red red square. If it's on me, then I can share. If not, then I cannot. Okay, good. I think now it's on me. That's great. Oh, thanks.
Okay.
Thanks for that tip as well. Is that me? Screen one. No, it's my screen. Not this one. No. Where is my screen too? Oh, sorry. That's the window. You can see me now, I think.
Now?
Yeah, that's good. Okay. Okay, good. You can all see my slides. That's great. Well, I think when I'm...
1 second,
You
you're
cannot...
sharing because I think that if you are, we are not seeing them yet.
Oh, okay. So it's not there? Okay, because my... Okay. I don't know. Let's see here.
So we can share from here.
Okay,
If you can share from your side, that's also good. Weird.
Okay, if you can share from here, please do that.
Where am I? Where am I? Okay, here.
Yes, on the website, the slides are updated, so can be shared from here.
I only sent you this morning, so...
yeah. No, but they are updated.
So
okay. Okay, here they are. Please fit them to the page.
Please, Janet, let us know when you can see your slides.
I don't see my slides
We
yet.
do see your slides. So.
Oh, you see my slides? Oh. Because in my window I can only see the window. Now I see the video. Oh, now I see my slides now. Yeah. Is it possible to make it?
Technical assistance. We lost Janet, I guess.
Huh? You lost me? I'm still here. Oh. You cannot see me anymore?
I can see you and hear you.
Yeah. Okay. So the slides, I see the slides is not full screen. Is that possible to make the full screen or?
So this is the full screen that I can give you, Janet. Can you see them?
I mean, I can, but this, I know this is not a full screen. Can I reshare again? Just, I don't know, maybe it's a little bit better. Sorry about that.
Yes, try again.
Okay, can you give me the sharing right again? Okay, I don't have the red yet. Our test yesterday was fine.
Okay, while the technical
that.
glitches with Janet will try to be solved, the idea is to move forward maybe with the second one, Zhu, Professor Zhu.
Okay, that's good. That's fine. If you can give me the sharing rights, I will try to share my slides. Thank you.
We don't hear anyone here. Non sentiamo nessuno qui.
Hello?
I can hear you.
Can you hear me?
Marco,
I
do
can
you
hear
hear
you,
us?
but I
Marco
think there
Petracco?
might be a problem in the...
Marco, I can hear you.
Yes, it looks like they have a problem in the in-presence part. Ferdinando, can you hear us?
Yes, now we can hear you. Yes. Is there
Okay.
anyone who's is ready to share, that can share? Because so that while
I was saying I can try to share. I was saying I can. Oh, okay. Now let me try to share my slides. Can you see my slides?
Fantastic. Yes,
Yeah.
we do see and hear you.
So it's working.
I think you conquered the floor by technical proofness.
Yeah.
Finally. Okay, let me just start. Thank you so much for putting this paper on program. And this is a joint work with Charlie Ken and Martin Van Noort. In this paper, we are thinking about the design of a digital currency. We are focusing on central bank digital currency, but they can actually apply to private digital currency too. So what we are thinking about is to use expiry date to facilitate loss recovery in case a digital currency wants to enable offline payment feature. Okay, so as we all know, a big advantage of physical cash is its resilience. It can be used without internet. So this is very useful in remote locations and in cases where the internet is disrupted by some natural disasters and or other reasons. And many central banks are thinking about having the same offline payment feature in central bank digital currency, but an implication of that is the balance that can be used for offline payment has to be stored separately in a tamper-resistant device and separate from online accounts. Why is that? Well, the reason is we want to avoid the double spending problem. The issue here is suppose we have a backup of the same fund online and also in an offline device. That means I can spend the money online and also use the offline device to spend it at an offline location. By definition, the offline location does not have internet connection, so they cannot check whether the money has been spent or not online. Therefore, that opens door to a double spending problem. Similarly, if we store the same money in two offline devices, I can use the balance in one offline location with one device and go to another location and use the same money with a different device. Therefore, this implies we have to store this offline balances uniquely in a tamper-resistant device, and it has to be separated from online payment balances. And an implication of that is if we lose a device, that means the fund is lost. Now, what we try to think about is, can we actually reduce the cost of losses by a design of a digital currency? Well, the answer is yes, we can do so by seamlessly embedding an expiry date to facilitate loss recovery. The idea is whenever you download a payment balance to your offline device, an expiry date is attached to it. If nobody claims the fund online before the expiry date, then this money is automatically reimbursed to the online accounts. And this leads to some interesting economic questions. First, it's about information sharing. What type of information you want the offline payment device to share with the central bank if the offline device connects to the internet? Second, how to optimally set the expiry date, how long this offline money should last. And this is the focus of our paper. And about information sharing, I want to be more specific to give you an idea what it is. So the information sharing is have the following problem. So when we say the money is lost and reimbursed, we have to figure out who has lost the money. There could be two cases. First, it could be the original owner of the offline money lose his device before he gets to spend it, so he should be reimbursed. It could be another possibility, that is, he has already spent his money, but it's the receiver of this money lost his device, and then in that case, he should be reimbursed money. Then how can we figure out who lost money? Depend on the information structure. That's the information sharing between the device and the central bank. We consider two cases, one with high privacy. That means syncing a device does not reveal whether this person has spent his money and where he has spent his money and how much he spends on money. That means syncing payer's device does not reveal any information about his past payment history. Then it's gonna be the payee who has to deposit the received balance before the expiry date. If he failed to do so, because no information is there, the money will automatically be reimbursed to the payer instead of the payee. Next, we consider a low privacy case. That means in that case, syncing the device reveals where and how much the payer spends the offline balances. In that case, payee still have to deposit balance before the expiry date. However, he has an extra insurance. If I fail to do so, and the payer happens to connect his device, that would reveal that it's the payee who lost the money. Then the money can be reimbursed back to the payee instead of the payer. So in the paper, we discuss both cases, but during the talk, I'm going to focus on the high privacy case. Now, let me briefly review the summary. First, we find that the loss recovery facilitated by expiry date could substantially increase the demand for offline payment balances, and that's welfare improving. Second, more information sharing between the consumer and the central bank improves the accuracy of loss recovery, but may not necessarily increase welfare. It actually can decrease welfare in some cases, so it's not necessarily a good thing in terms of welfare. And lastly, in terms of the optimal length of expiry date or value period, it seems that there is a asymmetry there. If you set an expiry date that's too long, the negative impact is small. But if you set an expiry date that's too short, the negative impact is really big. The reason for this asymmetry is that if you set an expiry date too long, the downside is only if I lose the money, it takes longer for me to get it back. And because I'm patient, that doesn't really mean much. But if the expiry date is set too short, then many sellers might realize that they will not be able to deposit the money before it is expired, so they will reject the money. As a result, no transaction could happen. And in that case, it's really bad. Okay, so in the rest of the talk, I will just tell you a small model to clarify all these trade-offs in an outage event. And then I will go to a bigger model with infinite horizon to illustrate the trade-off in setting the expiry date. And during the talk, when I mentioned cash, that is just some very instruments that can be used for offline payment. It can be stored value in payment card or in a smartphone chip. And cash allows for payment during outages, but is subject to losses. So the model has 3 periods, and t equals 0. the consumer decides how much cash to hold and how much online balances to hold. The online balances pays an interest, but offline balances do not. And after that, the consumer is hit by a preference shock. With some probability, he wants to consume 2 units. With some probability, he only wants to consume 1 unit in the next period. And period 1, first there are 2 shocks. One is there is some probability an outage occurs which disrupts the internet connection. Second, the consumer may lose his offline device and hence lose his offline money. After that, the consumer buys a good from the producer. If there is no outage, he can use his online deposits, but if there is an outage, he can only use offline cash. And consumption is bounded by the balances that can be used for the transaction. That's standard cash in advance constraint. After that, if there is no outage, consumer can deposit offline cash back to earn some interest. And t equals 2, first, an outage ends if there is one. After that, producers may lose his offline devices and hence lose his offline cash with some probability. And after that, everyone just withdraw, deposit cash, and online payments arrives. And in period 3, everybody go home, enjoy their money. And then let's look at the result. First, we look at the case when there is no expiry date. That means it's like physical cash, there is no loss recovery. In that case, there would be transaction during an outage, and the consumer would decide how much cash to hold, whether he wants to hold enough to purchase 1 or 2 units, depending on whether the benefits exceeds the cost. The benefits comes from consumption in outage, and the cost includes foregone interest and cost from a loss. Because in this case, he would not be able to recover the cash if he loses it. The cost is big. And he will bring in enough for second unit under more stringent condition compared to the first unit, because he only wants to consume the second unit with some probability, but he always wants to consume the first unit. And the social welfare is increasing in the number of consumption. Okay. Now let's look at the case where the cash has an expiry date, but just expired too quickly. It lasts for 1 period and expires at the beginning of period 2 before producers can deposit it. As a result, it is automatically reimbursed to the consumer. As the producers realize that they will not get the money, therefore what they would do is they would say we reject cash and hence no transaction occurs during outage. And the social welfare is the same as there is no cash, is going to be lower than that's the case without an expiry date. So setting an expiry date that's too short is bad. No consumption happens. Now, if the expiry date is set properly, like lasting for 2 periods, in that case, it will be transaction in the outage. In fact, all the terms of trade, the price is the same as if there is no expiration date. And in terms of cash holding, consumers want to hold more cash because if they lose the cash, he can get it back, but with some delay. Compared to the case when there is no expiry date, he loses it, he just loses it forever. So this reduces his cost of holding cash, hence increases his cash holding. And under certain parameters, that would also increase his consumption and improve social welfare. Okay. And I'm at the end of my talk, so I will just show you this graph where we go to a bigger model with infinite horizon as the outage length, how long the outage lasts is random, and we just plot the cash holding as a function of the length of the expiry date. And in fact, we calibrate the model to an online survey we conducted to figure out the probability of loss and stuff like that. And you can see clearly from the picture here. On this picture, I show you cash holding as a function of the expiry date. The optimal is around 20 that maximize the total cash holding. But you can see there is a clear asymmetry here. Once you move beyond 20, the cash holding is almost constant on the left panel, but if we zoom out, that's on the right panel, it decreases, but very slowly. But if you go set an expiry date that's too short, that's to the left of the around 20 days, you can see the expiry, the cash holding just reduces dramatically. That's because sellers start to reject cash in certain conditions, and then consumers find bringing cash is not so useful, so they reduce their holding of offline cash. And this graph is for consumer welfare. It's the same story. So there is an asymmetry in setting the expiry date. Okay. So that's my last slide. Let me conclude. First, we find that loss recovery based on expiry date can positively impact consumer demand for welfare, for offline digital currency balances and also welfare. As the cost of setting a longer expiry date is small, but if you say it's too short, that's really bad. I didn't get to talk about this information sharing very in details, but it's in the paper which says that more information sharing can actually be a bad thing for welfare. That's all I have. Thank you.
Thank you, and thank you for being so rigorous also with the timing. I would like to ask if there is anybody.
I have a question, if I can.
Yes.
Okay. Yeah. This is not very technical, but I mean, this is kind of a consideration on the attempt you're trying to describe, because for offline payments, the good old cash in its physical form might be good enough. So are you envisioning a future where physical cash is completely banned and not even available? Because, I mean, as an example, I'm more familiar with the European cultural debate, and even if European Central Bank is working on a digital cash, it's ensuring everybody that physical cash will not be phased out. Instead, if I get it right from your paper, you're envisioning a scenario where it is completely phased out, so that we do need devices in order to accomplish offline payment transaction. Am I right? Is this your personal view?
Yeah, it's considering a scenario where paper cash is not used that often, and we are replacing it with a digital payment. And of course, this is really just try to think about when one thing you can see we focus on an outage situation, right? That's really considering if we going forward as digital payment becomes very dominant in normal times, then as a result, people might not hold that much cash, and cash might not be used in normal time, and gradually people might just forget about it. But then if there is an outage occurs, we still want some resilience. That's what we are doing. So that's what we imagine to some extent.
Thank you. Any other question from the floor? Here in presence? Or? No, Marco, there are no other questions from the floor here in Milan.
Okay, thank you. So I will have a question myself. You have a model where basically you have that all currency that basically at the same time. So it's how much time they have left to be able to register the transaction. But what about a case where you would not be able to do that, and so you could have cases where you have long and short-lived currencies in circulation. I mean, have you tried considering that? And because that could create like several vintages of currency that are out there, and then sellers could be tempted only to accept, say, long-lived currency over short-lived currency, or they would have different values, basically.
Right. I think that's exactly one thing we have thought about. We think that the device would automatically renew. First, we think so. The device would automatically renew the expiry date once it's connected to the internet. So, and second, the sellers potentially they can allow to set on their device to say, I don't accept the money that's gonna expire soon, like in 2 weeks. I would not accept it. So it would cause rejection of some money in some situation, but still that will alleviate these problems because you can actually do automatically set up.
Thank you. Are there any other questions?
I think we have to move to the second presentation.
Yeah, I think that we have
actually
now
the first
solved
one. So Janet is here with us, and the slide will be shared from.
Since you are pretty good with sharing, can you share our slides that I sent to you in the morning? Maybe that's probably it's going to save us the time that way. Good. Oh, it's very reliable.
It's not me sharing; it's Lucy sharing.
Lucia is sharing. Yeah, whoever it's the same slides, so basically, yeah. Oh, this time is good. This time I can see it full screen. So, thanks, Lucia, for sharing this with the audience. Okay, so this paper about how CBDC is going to affect monetary policy pass through. So there's a lot of research on CBDC. I guess you just presented one, and this is another one we have together. And CBDC, or central bank digital currency, is just a response of central banks in response to the very fast development in the crypto currency world. And there are a lot of policies that are sort of associated with CBDC. Lucia, is this like auto turn, or because are doing the auto turn or still on the first slide? Can we do the previous slide?
When to move before or ahead, I will move for you.
Okay, so can you do the previous page, please? Okay, that's good. I will ask you to turn, and then you turn. Thanks. So one important question is how CBDC is going to affect the pass-through of traditional policy rates, and vice versa. So next page, please, Lucia. So we're going to sort of tackle this question with the sort of model we built for another paper, which studies how CBDC is going to affect the banking sector, in particular intermediation. So in the model, it's just for a simple model of banking. So banks, right, they provide financial intermediation and payment services. So here I show them the balance sheet of the bank. So on the liability side, it issues deposits to households, and households are going to use deposits for payments. On the asset side, the bank is issuing loans to firms to finance productive opportunities, and at the same time, banks also have to respect regulation that's in the form of reserve requirement. So we're focusing on CBDC as a perfect substitute for deposits as a means of payment. And of course, the design of CBDC is still up in the air, but we just take that as a first step, right? CBDC is going to be a retail payment instrument and is electronic, so it is going to compete with deposits as a payment method. In terms of the pass-through of traditional policy instruments, in this paper, we're just focusing on the interest rate on reserves. Next slide, please. Yeah, that's good. So given that I have like 15 minutes for presentation, so we're just trying to walk you through the main intuition of the mechanisms and sort of the main results, and you can sort of take a look at the paper if you want more details. So in particular, I'm going to do the analysis in 3 steps. The first one is I'm going to illustrate how interest rate on reserves affect the deposit and loan markets, assuming the banking sector is competitive. And I'm going to do that first without the CBDC, just to see what the pass-through looks like, right? And then the second step, I'm going to introduce CBDC to that environment, and then see how it is going to affect the pass-through of the IOR, okay? And the last step is we're going to do the same thing, but now we're going to look at the case where the banking sector is not competitive. In particular, the deposit market has corner competition and it has just a few banks. And the loan market, we're still keeping it competitive. Lucia, can you go to the next page, please? Okay, so the first one, I'm going to show you the mechanisms, right? How the interest rate on reserves is going to affect the loan and deposit market in the case of competitive banking and without CBDC. So I'm going to show you a series of graphs. Okay, so they're going to look like pretty much like this. See, on the horizontal axis, that's the interest rate on reserves. And on the vertical axis, have 4 variables. So the first one, the upper corner, the upper left, that's the deposit rate. And down there, we have the loan rate, that's the lower left. And on the right, we have the quantities. Right? The first one, the upper one is deposit, and then the lower one is loan. So the effect of IOR, we can split it in two cases. Okay, the first one I call it the complementarity mechanism, in the sense that so basically this happens when so you see a kink, all right, on the curves. Basically, this is before the kink. So when IOR is small, so that's when the interest rate on reserve is small. If that's the case, then the interest rate on reserve is less than loan rate. So banks would like to loan has a higher return, right? So banks would like to put more investment on loans, but they cannot because of reserve requirements. So they are going to hold just enough reserves to satisfy the reserve requirement. So in this case, right, then you look at the asset side of the banks, the reserves and loans, they are just a bundle, right? They are complements. So if we increase IOR, that is going to reduce the cost of making loans, okay? So that's why the bank is going to expand the business. So if you look at the right hand of the two panels of the graphs, so both deposits and loans are going to expand, okay? And then we look at the rate on the left. So now we have a lower cost of making loans, and the bank is going to, so they're competitive banks, so they're going to pass on this benefit to both depositors and the firms. For depositors, it's going to show up as a higher deposit rate. I know the graph is a little bit, it's a very mild increase, but it's increasing. And then the loan rate is going to decrease, right? So basically, both depositor and the firms are going to enjoy this lower cost benefit. Next one, please, Lucia. Okay, so the next one, that is one. So we're going beyond that kink. So IOR becomes large. So when interest rate on reserves is large, then the banks are willingly holding reserves. In this case, so again, look at the asset side. You have loans, you have reserves, and then in this case, these two assets must give you the same return, right? Because you can sort of move your funds between these two asset categories, right? You're going to stop when these two types of assets give you the same return. So in this case, then reserves and loans, the relationship sort of changes, reverses basically. So here they're going to become substitutes. So a higher reserve rate means that your reserves become like more, it becomes more appealing, right? So that's why banks are going to decrease their loans. So that's the lower right corner of graph. So you can see the loans are decreasing, and at the same time reserves are increasing. So reserves are not shown in the graph. And in terms of sort of pass through to to deposit rate. So now the asset side, right, because the return is higher, right, and the banks are going to sort of just pass on this benefit to depositor as a higher deposit rate, and deposits are also going to increase. That's the upper right graph. Okay, so you can see, so depending on the relationship between reserves and loans, or depending on the IOR, it is the magnitude of the self, the pass through to the loan and deposit markets can be very different. Okay, let's go to next page, Lucia. So now I'm going to introduce CBDC, right? So the CBDC, so I still keep the graphs without CBDC. That's still the red lines, and the dashed line, the blue lines are the case where we have CBDC. So CBDC, as I said, is going to be a perfect substitute in terms of payment functions for deposits. So that's why CBDC rate, the interest on CBDC rate, is going to become a floor for deposit rate, right? So if you go, so if the bank is offering something lower than CBDC rate, you're not going to go to the bank, right? So that's why CBDC becomes a floor. And it's going to become effective floor. So if the deposit rate, that's the upper left graph, right? If the deposit rate is lower than the CBDC rate, and in this numerical exercise we're having 1.2, that's the CBDC rate. So if the deposit rate is less than 1.2 or CBDC rate, then CBDC rate is going to become an effective floor, right? So the bank will be forced to pay that to pay that rate. So that's why if you look at the deposit rate is flat. Is fixed as the CBDC rate. And in terms of, and if you compare the sort of the blue line, the blue dashed line, and the red line, you can see that if we look at the deposit rate and loan rates, okay, it's going to force up a deposit and loan rate. For deposit, we don't really know, right? It's just a floor. So yeah, the banks have to match. And then for the loan rate, the banks have to fund this higher deposit rate. They have to pay their depositors for high rate. So they will have to sort of charge a high loan rate as well from the firms. So that's why sort of loan rate is also higher, compare blue and red again. And in terms of the quantities, look at the right panel, the two graphs, you can see that both are decrease, so both are lower. So the blue curves are lower than the red curves. So in this case, CBDC is crowding out intermediation. Okay. Okay. So now in terms of the pass-through, it's going to. So again, we can sort of look at the two cases here. So so one case is where, so I'm showing the case. So look at the situation before the kink, sort of the kink of the red curves, right? So if that's the case, then with or without the CBDC, the reserve requirements is binding. Okay, actually the CBDC, I think we sort of in the last slide I guess went a little bit fast. So that slide also show also because the CBDC forces up the loan rate, right? That makes the reserve requirement more likely to bind, right? Because loan rate is higher, right? Loan rate is higher than the reserve rate, so yeah, banks would want to put more assets on loans. So the reserve requirement becomes more binding. So in the before the kink, without a CBDC, the reserve requirement is binding. Then we still have the same complementarity mechanism. Okay, and when IOR increases, the bank is going to issue more loans and deposits. But in terms of pass through to loan rate, we're going to have a stronger pass through. Okay, the reason is now is because before, okay, without the CBDC, we say that the benefit of the lower cost of incurred by a higher IOR is passed to both deposit rate and loan rate. So now, because the deposit rate is fixed at the CBDC rate, right? So it's not changing anymore. So that's why everything's going to be passed to the loan side as a loan rate. So that's why the pass to loan rate is going to be stronger with CBDC. I know in the graph it's not showing very clearly, but the blue curve, so the blue curve for the loan rate should be steeper than the red one. Okay, next one. Next slide. And so if we go beyond the kink of the red curve, okay, then CBDC actually is going to make big changes here, in the sense that it's going to change the reserve requirement from being loose to binding. So as I said, CBDC is forcing up the loan rate, so that's why they make the reserve requirement more binding. So yeah, if the reserve requirement is changing from being loose to binding, then the sign of the pass through to the loan market is going to be completely reversed, right? So look at the blue curve and the and the red curve and lower panel, that's for the loans, right? So they are moving in opposite directions, right? So with the red curve, it's increasing, and with the blue curve, it's decreasing for the loan rate. Okay, and for the loan quantity, it's the opposite. And we're also going to see like a big jump here at the, so if you look at the deposit, we see a jump, right? If you look at the blue curve, it's a jump. And so that happens when the IOR rate is equal to the CBDC rate, okay? So at that moment, what happens is that the bank is taking over all the liquidity previously held in the form of CBDC. So and then they are going to sort of fund this increasing deposit with excess reserve. So that's why we see that jump there. Okay, after that moment, then CBDC is not going to affect the economy anymore. Okay, so that's the case with as for competitive banking. I show you how the sort of CBDC is going to change the pass through of CBDC. Now, Lucia, can go to the next one? Lucia, yes, last one. So now we're just the last part of the 1 minute. Should be good. Yeah, that's the last part of the sort of the analysis. So now we're going to look at a different market structure. So before we assume the banking sector is competitive, now we're introducing sort of market power on the deposit market, right? So how this is going to change? So again, so I'm showing the red curve and the blue curve, right? One with the red is without CBDC, and the blue one is with CBDC. And you can see the general pattern. If you look at the red curve without CBDC, right, you can see it's very similar to what happened before, at least in terms of pattern. So we're still going to have the two mechanisms, so the substitution mechanism and the complementarity mechanism. And then we're still going to have CBDC dictating the deposit rate, and one is effective. So that's the sort of deposit as the upper left corner graph. And what is different from the competitive case is that now with an intermediate rate, CBDC is going to expand intermediation. So this we showed very carefully, or in very much detail in our previous paper. So and the reason is when the bank has market power on the deposit market without CBDC, the bank is offering too little deposit and at too unfavorable terms. That's a too low deposit rate, and on the loan side is also the loan rate is too high. So now with CBDC, what happens is that the bank is going to lose their ability to influence the market price. That's the sort of deposit rate. So in response, what is going to happen is that the household, they want to have more liquidity here because just because the return on CBDC or deposit is really higher, so they want to hold more deposits, and then the bank is going to cater for that higher demand because they're in terms of a profit, they're still making sort of positive profit, so that's why they're going to match the deposit rate, and they're going to expand the their balance sheet, so both deposits and loans are going to increase. So so that's why when you compare the blue and red curves, or the blue curves are sort of higher than the red curve on the right, that's the quantities. And it's also going to relax the reserve requirement. Okay, this is going to have some implications on the sort of the as pass through. And the reason is the CBDC is forcing down the loan rate, right? So with that is going to relax the reserve requirement, right? Making loan sort of relatively not appealing relative to the reserve. So that's why the reserve requirement is relaxed. Okay, next one. Okay, so that's pretty much the second last slide, and I will conclude right after. So, so again, so when we have the okay, we're going to still have the different cases here. So, so the first case is when R is low. Okay. Then again, so the reserve requirement is continue to bind it with CBDC. Okay, it doesn't matter whether CBDC or not is binding. So when R increases, what happens, different from the competitive case, that now CBDC fully dictates the economy, okay? And here banks don't want to pass the benefit to deposit and loan anymore, okay? Because they are already forced by CBDC, right, to offer pretty high deposit rate and a pretty low loan rate. Now, if IOR increases, yes, their profits are going to increase, but they're not going to pass on this anymore. So that's why in the first part, the sort of the pass through is pretty much muted. Okay, next one, please. Okay, and then we're also going to have the reverse of a sign. Okay, so this, as I said before, because the CBDC suppresses the loan rate, so that makes the sort of the regulatory requirement from binding to loose. So that's why we're going to have a sort of reverse of the sign of pass through to the loan market, compared with the case without CBDC. Okay, now I'm going to sort of conclude right now. So next one, please. So okay, just to summarize what we see, right? So we see that so when we introduce CBDC, right? Then if we look at the effect on pass-through of IOR, so one CBDC is effective. If you look at the deposit market, CBDC, of course, is going to sort of block the pass-through of IOR to deposit rate because it's a sort of effective floor, right? So that's why you don't have a pass-through from IOR to deposit rate anymore. In terms of deposit, okay, depending on whether the bank have a market power or not, right? It can also, if the bank has market power on the deposit market, and then the pass-through to quantitative deposit is also going to be muted. And on the loan market, right, depending on the market structure, it could strengthen the pass-through of loans or reverse signs of pass-through by tightening the reserve requirement. In the case of a coronal deposit market, and then you can have something like the opposite. So basically, the main message, I guess, from this work is that the central bank, they should be mindful about the effect of the CBDC on traditional monetary policy instruments. So once you have CBDC in the economy, you have to, you know that something's going to change, right? So that's why you need to pay attention to that, and also there should be some coordination between CBDC and the traditional policies. So yeah, just the innovation wasn't going to happen if we introduce CBDC to the economy. I think that's the last slide. Thanks. I'm going to just put it over time.
Thank you, Janet. I think as we are with sliding in terms of our time, I will allow one question, and then we will move to the next one. If anybody has questions from the floor.
I have a question.
Ferdinand.
I'm Paola Bongini.
Yeah. Hi, Paola.
For you. Hi. In your model, you are assuming that the central bank digital currency bear an interest. And my question is this necessary to consider that any CBCD should bear an interest? Because if they are a substitute for cash, digital, well, so they have to perform the very same feature of cash, apart from being digital and not physical. Why should they promise an interest rate? Can we consider a central bank digital currency with no bearing interest?
So, yeah, but this is a question I guess we got asked quite a bit. So I think a lot of central banks, at least when they are contemplating the CBDC, I think when they, at least in the initial stage, they will consider only non-interest bearing CBDC, right? So non-interest bearing means a zero. So zero is still an interest rate. It's just it's zero. And then what we showed in our other paper is that if the economy goes like a cashless, so even if the CBDC is so not interest bearing, at some point, right? Because when they can become increasingly cashless, if the banks have market power, they may start to like charge you like a fee for a deposit, right? So and then in that case, this even if a sort of zero interest CBDC is going to become effective. So I think all of the analysis I just showed to you, it just, yeah, I mean, CBDC it's going to have some interest rate. That's like 0 or 1.2. So in that sense, as long as that's a rate, right, it may become binding and it's going to affect the economy.
Thank you.
Yeah, thanks.
Thank you. I think, as I said, unfortunately, timing is a bit tight, so I would like to move for the time being to the next speaker, and then we will see if we have additional times for general questions. I also have a question, but I will send it to you maybe separately.
Yeah, thanks, Marco.
But
Katharina is almost
not
ready.
sure is Katharina Filip is.
She's here in Milan,
okay.
and she's trying to...
Milan, yes.
Yes, she's trying to share her screen.
So, okay, perfect. So, hi everyone, it's great to be here in person as well, and to this great conference. And do you see my screen share? Yes, okay, all right. So perfect. So I'm really glad to be here, and I'm glad to present my latest work on the transition dynamics from government money only to differentiated cryptocurrency competition. And if we want to talk about transition dynamics, we first have to ask ourselves some questions. And the first question is, why do people even need and hold money? So there's a broad discussion on this aspect, and there are several different features money can serve as, for instance, cash purchases or holding reserves for future payments, some standard for deferred payments, and a reliable unit of account. And I will focus mainly on the transaction function of money, so the function of money that really facilitates trading and makes it easier to trade. So this is the point I'm going to focus here. And the next question we need to ask ourselves is currency better supplied by a monopoly currency, so a monopoly national currency as we are kind of used to it now, or would competition as well be beneficial in this context? And there was a great discussion, mainly driven by Hayek and Friedman, on the fact that if the benevolent central bank is a better option for an economy, or is the profit maximization motive better for supplying some currency and achieving better results in an economy. So would competition be beneficial? And this discussion gets a revival with the existence of cryptocurrencies, because cryptocurrencies could perform this competitive environment. And if we have some alternative currencies, we need to ask ourselves, how would people adopt these alternative currencies? Because there's also a broad literature on currency adoption and currency usage, and especially in this transaction function, you know, the basic value of each money comes from the fact that someone else is going to accept it. So you can pay, and you know you can spend your money. And so the basic value arises from the network effect. And this network effect, in contrast, also pushes towards monopolization or pushes away currencies that are not fully accepted. because whenever you hold some currency that has not full acceptability, like legal tender, government money, you're always a bit worse off because you can't be sure that so many people accept it. So the networks effect are pushing towards monopolization and just one currency in circulations. But nevertheless, we also have to look at how does the behavior and money holdings of agents in an economy change if there would be more currencies available. And therefore, I choose a new monetarist model and analyze the transition dynamics in this model. And this model basically based on the work of Lagos and Wright and Williamson and Wright. And so first, some introduction to cryptocurrencies. I think as far as you know, they are a peer-to-peer electronic cash system, at least Bitcoin was. And after the launch of Bitcoin, the number of altcoins rose rapidly. And the special feature about cryptocurrencies is that they are not perfect substitutes. So they can inherit different characteristics. So some may provide a greater anonymity, whereas others have a greater, shorter transaction time or higher transaction costs. Some are meant to be stable, some are more volatile, so they are not the same thing. They're not perfect substitutes. And this is essential. Furthermore, they could enable a wider functionality if you think about smart contracts and their application in DApps or decentralized finance or in the tokenization of the economy. So overall, there exist various different reasons to hold and use a cryptocurrencies. And furthermore, this blockchain technology and therefore cryptocurrencies keep improving all the time. So that we don't have reached the over-the-top best yet, but there is still some progress. Okay, with this in mind, let's keep on the modeling. As the model is rather complex and mathematical, I will focus on the intuition and results in this presentation. And if you have further questions regarding the math, just ask me or take a look at the paper. So as the new monetarist model is a micro-founded macro model, so it's based on agents' decisions and we can analyze macroeconomic outputs in there. As it's micro-funded, we have a continuum of agents, so there are lots of agents in our economy. They live forever, and these agents have to decide each period how much they want to work, how much they want to trade, and finally how much they want to consume to maximize their utility with a discount factor beta for the next period. So every period the agents does these decisions to maximize utility, but every period is as well divided into two sub-periods, a day market and a night market. Why do we do this? It's the fact to account that trading sometimes is easy. You can perfectly coordinate yourself and you really achieve the trade you want to. So this is kind of the centralized market where everyone trades without loss of generality, a general good X. And otherwise, trading is sometimes more difficult. You have trouble finding a trading partner. And so we accounted for it with the decentralized day market, where each agent is bilateral random match with some other agent, and they trade specialized goods. So each agent trades a different good and consumes a different good. And therefore, the value function is a bit more complicated, and trading is a bit more complicated. So what's the role of money in all this model framework? Important aspect is that the use of money basically is not necessary, but it may enhance trading. So we focus on this transition, on this transaction function of money. In the day market, you can either have a single coincidence meeting, and since it's a single coincidence meeting, you need money. So you need to pay or receive money for the specialized goods. So in this special factor, it's necessary to use money. Otherwise, if you are randomly matched in a double coincidence meeting, it's optimal for both agents to barter trade their specialized goods. In the night market, since it's a centralized market and you trade a general good, it doesn't matter if you pay or barter trade this good. So overall, you can hold money and it could be beneficial in the decentralized trading for an agent, but it's not necessary. And this is exactly what agents need to decide. So they need to decide how much money they want to save at the end of one period and take into the next period to maybe get a better chance for trading and a higher probability of a successful trade if they are matched in a single coincidence meeting. And after some optimization stuff, utility optimization during the night and day market, we get an optimal portfolio choice equilibrium condition for each agent, which basically states that the value fee of each currency an agent wants to hold now at the end of the night market needs to equal the expected value of this currency during the whole next period T+1. So what's the intuition behind it? Each coin offers somehow a liquidity premium. It's denoted by L in here. And this liquidity premium differs in the rate of acceptance I introduced in this model framework. The rate of acceptance is the parameter mu you can find in there. And so if you have a government currency which is fully accepted, so you can be sure that any agent you meet in the decentralized trading is going to accept your currency, your mu is the fullest probability, so it's equals 1. Any cryptocurrency is likely to have a weaker acceptance, and therefore the acceptance is going to be somewhere less than 1, resulting in a lower liquidity premium. So the liquidity service the money is going to provide you is less than any currency with full acceptability. The second feature is I introduced in this model framework is the additional value called Y. And this additional value accounts for the fact that cryptocurrencies are not perfect substitutes. So this additional value you can imagine is the greater anonymity you receive or the faster transaction times or even the probability, the possibility to deploy a smart contract on the blockchain. So all these features cryptocurrencies differ in are captured by this factor Y. And as the government currency is per definition a fiat currency, it does not offer any additional value. All right, then we can calculate some equilibria. The first equilibrium, which is worth looking at, is the equilibrium if we just have one government currency. So it's basically the state we are more or less right now. And this is denoted in the brown line and the brown dot. And we see we have one steady state equilibrium with the traded quantity Q hat and an equilibrium trajectory converging to zero trading activity. So that steady state equilibrium with Q hat would be quite nice, as well as the government currency would provide stability in this equilibrium. But there are these these equilibrium trajectories converging to a lower or even zero trading activity. And foremost, this trading activity is in the steady state is not the socially optimum trading activity as defined by Friedman. So we have a steady state which is quite nice, but it's not optimal. Otherwise, with cryptocurrencies, there exists a competitive steady state, which is a unique steady state, delivering the socially optimum trading output, Q star. It's marked in green in here. And this equilibrium we can reach if all cryptocurrencies provide the maximum feasible additional value Y star, or saying other way around, they perform the best they can. So these additional features enhance the trading activity. And furthermore, cryptocurrencies would provide or could provide a stable value in this equilibrium, and the government currency would need to impose a deflation rate, and this deflation rate is equivalent to the Friedman deflation rate. So the big question is, how do we get from the government money only steady state to the socially optimum steady state with cryptocurrency competition? So let's assume, first of all, we are in a situation with just one government money, and at time S, an alternative cryptocurrency becomes available in the economy. But as said before, this alternative cryptocurrency is more likely to have a lower acceptability, so not everyone is going to accept it in the decentralized trading, and therefore the network effects prevents the circulation of this cryptocurrency. But as cryptocurrencies are not perfect substitutes and may offer some differentiated characteristics and additional services, these additional services can compensate the lower acceptability. And at time t, the additional services this cryptocurrency provides weigh out the lower acceptability, and the cryptocurrency is able to start circulating in equilibrium. And from this point on, we move on with some transition dynamics, as stated on the next slide, until we reach the time t star, and there we reach the socially optimum unique steady state equilibrium I showed you before. With the socially optimum trading activity as well, the economy would benefit from. So how do we move in this transition dynamics field? Well, you know, cryptocurrencies are technology-based, and this technology improves all the time. As said before, the technology grows, and as the technology grows, we assume that the additional service grows as well. And as the additional service grows, every period as well, the trading output in the economy grows to our modeling through the equilibrium condition in our modeling. And due to this path, the economy converges to the, again, marked in green part, socially optimum trading activity. So how do the transition dynamics look in more detail? As said, the additional service grows every period with some growth rate, and this growth in the additional service encouraged the money holdings of each agent, so the money holdings increase. This increased money holdings leads to a higher trading output, especially in the decentralized market, because the more money an agent holds, the more likely he is that he's going to trade successfully in the single link coincidence bilateral decentralized trading. And as the traded quantity increases, the government money needs to increase its rate of return to stay valid in equilibrium, or other way around, it needs to deflate. And according to these dynamics, the economy converges to the first best unique steady state equilibrium, where the cryptocurrencies perform the best they can. Cryptocurrencies are stable, and we have the socially optimum trading output with the Friedman rule on currency in case of the government currency. So what happens in our model framework if we don't have just one cryptocurrency, but we have several competing cryptocurrencies in equilibrium? Well, the fundamental dynamics and properties persist as long as the free entry condition and market clearing conditions are still fulfilled. Each cryptocurrency which wants to get circulated needs to compensate the lower acceptability via some additional values. And if it fails to do so, it will fail and competition would drive it out of the market. And the issue of the cryptocurrencies may also lose their business. So the perfect competitive environment disciplines the behavior of all currencies in circulation. And especially note that the same amount of additional value does not imply the same additional value per se, because it just states that the additional value for any agent needs to be the same, whether this is a greater anonymity or a greater a faster transaction time or some other wider functionality. It doesn't matter in this framework. So the currencies are not perfect substitutes, even if they provide all the maximum feasible set of additional value in the first best equilibrium. So just briefly, what's with the acceptability? Well, we assume that the agents observe this enhanced trading activity with cryptocurrencies, and they observe that the trading output is increasing due to cryptocurrencies, so they start to learn about the new possibilities, and more agents to decide to accept these currencies. So therefore, we assume that the acceptability of a currency increases somehow related to the output growth with a lag of 1 period. And therefore, the transition dynamics basically look quite similar. So we have as well the additional service grows with the growth rate. Therefore, the money holdings increase. And this increased money holdings leads to an increased traded quantity. But now we assume that this increased traded quantity as well leads to an increase in the cryptocurrency acceptance. And due to the equilibrium condition as an endogenous result of this model framework, the traded quantity again increases. So we kind of create a positive feedback loop, which is quite familiar in digital markets and digital goods. And yeah, as well, the government currency needs to increase its rate of return. So in the last slide, I also did some simulation work. I decided to use some functional forms and calibrated the parameter values and choose different initial states. So we have the economy you saw before, it's the brown line. And as you can see, on the one hand side, the convergence of the traded quantity to the social optimum over time. And on the other side, you see the acceptability growth. And as you can see, the acceptability does not really grow that much, especially in the brown baseline economy case. But as you see that we assume, for instance, an economy which is more struggling. So let's say it's the blue one with a quite lower trading activity at first. First of all, this economy profits way more from the introduction of cryptocurrency competition because the trading activity is raised up way more than in an economy which is not economically struggling. And as well, the currency acceptance, the cryptocurrency acceptance raises way more. But nevertheless, it's far away from getting fully accepted, and the results points towards various cryptocurrencies establishing themselves in various niches, so various niche monies with different characteristics and different features. So as a conclusion, to sum up, first of all, the economy can profit from differentiated cryptocurrency competition through an increased money holdings and enhanced trading activity. And the main drivers for cryptocurrency adoption and economy transitions are the different characteristics and value-added services of cryptocurrency, as well as the growth of the technology to overcome the strong network effects in the market for currencies. Furthermore, cryptocurrencies established themselves as various niche monies serving different consumer needs. This is also in line with the ideas Hayek had in terms of competitive currency scenarios. And cryptocurrency competition can lead to cryptocurrencies price stability and a stable government money deflation rate. Yeah, but nevertheless, as any mathematic modeling, one should be a bit cautious with these results because this model builds for sure about restrictive assumptions and simplifications. And furthermore, deflation is generally not seen as a desirable outcome for monetary policy, at least not overall. And as cryptocurrencies are really highly interconnected systems, and there are many features you need to take into account and have a look at, systemic risks and network risks might also be an interesting field for future research. And yeah, I'm looking forward to it.
I have a question, if I can.
Yeah.
Well, first off, congratulations for this work. I'm pretty sure that Hayek will be very happy that the Austrian School of Economics still has some rooting in Vienna, and so in Austria for real. And the quantitative evidence that the monopoly of money is not benefiting the economy is very much appreciated, especially in this cultural environment where sovereignty about money is a dogma that cannot be touched. But I was wondering if you feel like your model could be tested on some real data from the El Salvador experiment of using a cryptocurrency as Bitcoin with legal tender?
Yeah, for sure. This model could be as well fitted with actual data, so you could really use actual data from, especially El Salvador would be a good example, and calculate the outcomes for the economy in there. This would be some further research I plan to do as well, to really use actual data in this model framework and estimate the parameters. Yeah, there had been some work on the monopoly of money as well with real estimation data from Lagos and Wright, for example. So it definitely is possible to, yeah, and it's meant to fit in real data as well.
And also, in your model, you have more than one cryptocurrency in equilibrium to compete with. Do you think that this is a stable outcome, or cryptocurrencies will compete up to a point that one is, result in the only one to be used because it has a greater usage and services given to consumers and traders? And do you envision the possibility they can rule out government money?
Cannot hear
Very
you,
interesting
sorry.
question, thank you. So first of all, no, I don't think that cryptocurrencies would really rule out government currency, and this is as well some special feature of this model framework. So there still is some government money in equilibrium, and I think this would quite probably be the case to have some really monitored currency in this competitive environment as well. And regarding different cryptocurrencies, yeah, I think in the end, it's moving towards establishing several cryptocurrencies which are the best in their specific characteristic, and all the others are going to fail in a way or get driven out of the competitive market after some time. So it's really a dynamic process, and in the end, equilibrium, I imagine more or less being one cryptocurrency in each specific field. So one cryptocurrency providing a lot of anonymity, one cryptocurrency that's very fast, or more or less two cryptocurrencies. But I don't imagine a world where we have really thousands and thousands of cryptocurrencies. No, I don't think so. Thank you. Any other questions?
Thank you. I think that
I hope
we are a
Marco
bit
is still up there,
tight
but I
on
think
timing,
that
so
we're
I
running
would.
short of time.
Yeah,
So
so
I
thank you very
fear
much.
that. Thank you very much. And I
Marco,
think
I
I
hope you're
will.
still with us.
I also have a question on this, but again, I will send it to you. So
Otherwise,
some comments
I will
on the
directly leave the
things. But
floor to
I think we
Professor
now
Peng
need
Wang,
to move to the last
which was
presentation.
connected before. I saw him, so let's get back to
Can
remote.
you hear me?
Yes, Marco, we
can
can.
hear you.
Yeah. Okay.
Okay, and we can see your content as well.
We also see Professor Wang's slides. We are just
Yeah.
missing
Okay.
him.
Thank you. Thank you for including our paper in this session, and thank you for coming. Today, I'm going to talk about stablecoins. To capture stablecoins' risk transmission effects, we call our paper the crumbling wall between crypto and the non-crypto markets. This is a joint work co-authored with Professor Yiping Huang, Juan Lin, and Yang Ji. In common perception, the crypto and the non-crypto markets are isolated from each other because cryptocurrencies are based on fundamentally new technology, independent of central banks, and do not commute with traditional factors. However, if an invisible wall existed in the past to block risks between the crypto and the non-crypto markets, the wall seems to be crumbling now. For example, earlier this year, when the Fed announced the plans to increase interest rates, the overall crypto market fell. So, what explains the recent link between the crypto and the non-crypto worlds? This is where our study kicks in. Stablecoins have developed rapidly in the last 2 years. We argue that stablecoins have bridged the gap between the two markets. On the one hand, stablecoins are a special kind of cryptocurrency. They are pegged to non-crypto assets to keep their prices stable. The most popular peg is the US dollar, usually one stablecoin worth 1 unit of US dollar. On the other hand, since stablecoins are stable, investors usually use stablecoins to settle their crypto trading. Thus, stablecoins are functioning as a digital fiat in the crypto market. Combining the pegging mechanism and the digital fiat rules, stablecoins are naturally linked to both the two markets. So, they can bridge the invisible wall we mentioned in the beginning. We investigate the risk spillovers among 3 asset categories: stablecoins, traditional cryptocurrencies such as Bitcoin and non-crypto assets. There are two major findings. First, there are bidirectional risk spillovers between stablecoins and non-crypto markets, and between stablecoins and crypto markets. Second, the dominant spillover direction is from the US dollar to traditional cryptocurrencies through stablecoins. Because stablecoins follow their pegs, it is intuitive the risk spillover is stronger from the US dollar to stablecoins. And because stablecoins function as a digital fiat in the crypto market, it is natural the risk spillovers from stablecoins to other cryptocurrencies are also stronger. Before we move to formal analysis, let's look at this graph. The following graph compares price histories of typical assets in the crypto and the non-crypto markets, that is Bitcoin and the US dollar. Before stablecoins were widely adopted, the prices were uncorrelated. After stablecoins become popular, the price become negatively correlated. The graphs intuitively demonstrate our story. And now let's turn to the next part, data and methodology. The data are obtained from two sources, Coin API and CryptoCompare. We focus on the sample period after stablecoins become widely adopted, from 2019 to 2021. We also conducted robustness checks using data from 2015 to 2017, the period before stablecoins were widely adopted. We need price series for all three kind of assets, stablecoins, non-crypto markets, and traditional cryptocurrencies. To proxy the non-crypto markets, we use the US dollar. One reason is that US dollar is the most important currency in the non-crypto world, or the global financial system. Another reason is that more than 90% of stablecoins are pegged to the US dollar. So, if we want to capture the relationship between stablecoins and the non-crypto world, the US dollar will do a good job. In robustness check, we also consider alternative proxies for non-crypto markets. For the traditional crypto markets, we choose Bitcoin and Ethereum, which are the two most popular cryptocurrencies. For stablecoins, we choose Tether and DAI. Both of them are pegged to the US dollar. Tether is the most popular off-chain collateralized stablecoin, and DAI is the most popular on-chain one. And now let's turn to the methodology. To capture the risk spillover effects, we will compare the COVAR and VAR. Here, VAR is the value at risk. For example, if in extreme circumstances, stablecoins are at risk and the price drops 8%, then we say the VAR for stablecoins is 8%. COVAR is the conditional value at risk. For example, conditional on the US dollar dropping. If the stablecoins drops 15%, then the COVAR is 15%. We can see that COVAR of stablecoins is different from its VAR, so we can see that there are risk spillovers from the US dollar to stablecoins. In contrast, if conditional on the US dollar dropping, the COVAR of stablecoins is still 8, the same as its VAR. Then the condition of US dollar does not affect stablecoins, and we could see that there are no risk spillovers. Let's move to the result part. As expected, we find significant risk spillovers between stablecoins and the US dollar and between stablecoins and the traditional cryptocurrencies, which confirm the role of stablecoins as a risk transmitter and supports our hypothesis of the bridging effect between the crypto and the non-crypto markets. Second, the tests also confirm an asymmetric effect in risk spillovers. That is, the risk spillovers from the US dollar to stablecoins and then to cryptocurrencies are stronger than those in the other direction. For stablecoins and the non-crypto market or the US dollar, we test whether the risk spillover is significant and which direction is stronger. Let's look at the graphs here, and they are more intuitive. The left graph represents risk spillovers from the US dollar to stablecoins, and the right graph represents the other direction. In the left graph, we plot VARs of stablecoins using the green and black lines. And we plot COVARs for stablecoins conditional on the US dollar using red and blue lines. We can see clearly that the COVARs are significantly larger than the VARs, which means there are significant risk spillovers from US dollar to stablecoins. And similarly, in the right graph, the VARs and COVARs for the US dollar are also different, which means the risk spillovers from stablecoins to US dollar are also significant. And we can compare the two graphs here. The difference between COVARs and VARs is larger in the left graph, and which means the effects are stronger in the left graph. That means the risk spillovers from the US dollar to stablecoins are stronger than the other direction. Similarly, we did the same for stablecoins and cryptocurrencies. We also found significant risk spillovers, and the effects are stronger from stablecoins to cryptocurrencies. So we find that stablecoins are linked with both the crypto and the non-crypto markets. They would transmit risks. That's how the wall between crypto and the non-crypto markets is crumbling now. Then it's natural to test for spillovers directly between crypto and the non-crypto markets. According to our story, before stablecoins were widely used, the risk spillovers should be insignificant. And after stablecoins become popular, the risk spillovers should come to play. So we compare the direct risk spillovers for two periods, the pre-stablecoin period and the post-stablecoin period. As expected, the result confirms our story. In other robustness check, we also use alternative indexes to proxy the non-crypto markets. The results remain the same. We also conduct tests on other types of stablecoins. We find our story mainly apply to stablecoins pegged to the US dollars. To sum up, there are two takeaways. First, we find significant risk spillovers for stablecoins with both the crypto and the non-crypto markets. If there used to be a war between the crypto and the non-crypto markets, thanks to stablecoins, the war is crumbling now. Second, the effects are asymmetric. The dominant direction goes from the US dollar to stablecoins and then to cryptocurrencies. There are important policy implications. First, we are at a crossroads here. On the one hand, stablecoins are entering into the wider financial system. Visa already accepts them in payments. On the other hand, regulators are not reacting quickly enough to set rules for it. Should we accept stablecoins as payment currencies? Or should we be cautious, wait and decide after more evidence is in? And we suggest the cautious approach because stablecoins are risk transmitters and could bring risks to broader financial system. And second, crypto markets are usually viewed as independent from central banks. They used to provide a way for small economies to de-dollarize. However, the asymmetric results show that the US dollar is exerting influence on the crypto market. Then there is a tendency towards the re-dollarization for cryptocurrencies. So that's what I want to share with you. Thank you so much for your attention.
Thank you very much. I would like to ask if there are any questions from the main room, from the in-presence room.
Yes, there is a question from the floor here in presence.
We should have a mic.
I think this will work.
Okay, yes.
Okay, this is awkward. So, very interesting paper. I was wondering, clearly there's other stuff going on in the pre-stablecoin and post-stablecoin periods. In the pre-stablecoin period, we have like the ICO build-up and all of that. And in the post-stablecoin period, we have COVID, amongst other things. So that alone is probably not direct evidence of an effect that stablecoins have on any spillovers between cryptos and other assets. So I was wondering if you have an idea if there's other tests you could do. So two things that come to mind. One would be to maybe look at different stablecoins that are pegged to the US dollar and pegged to something else and see if there's some variation that you could exploit. The other idea would be to maybe look at trading volume in stablecoins or investor attention towards stablecoins and see if there's variation that you could use to see if this correlates with any spillovers. Thanks.
Thank you. Thank you for your advice, and I will do the test. I will do the test in the further analysis. Thank you.
If you want to reply, or
yeah. Can you hear me?
question?
I suppose it's okay.
We lost
Yeah.
the presenter. You scared him.
I think they cannot hear you from the main room. Probably.
Yes.
Yes.
I think yes. I think now. Can you hear? Can you hear us from the main room?
We do hear you from the main room. We do not see the speaker anymore.
Really? Really? What happened?
Okay, now we hear you. Okay, you can answer.
Oh.
If you got the question, you can answer. Thank you. Sorry.
Yeah, that's a very good. That's a very good advice. Thank you. And I will do the other test that gentleman mentioned before in further analysis.
Just a clarification,
Yeah.
if I got it right. So you're suggesting that after the introduction of stablecoins, the relationship between cryptocurrencies and US dollars or the S&P 500 or the gold has become from uncorrelated to correlated but negatively correlated, which is in the investment arena is good news, or would it be considered very good news to find instead of uncorrelated to negatively correlated assets?
Yeah, I I can't say it's a good news or bad news. I think in our work we find the stablecoins has a destable function, not as their name suggests. So maybe it's a concern for regulators to take care about. Yeah,
Thanks.
that's all, I think. Thank you.
So thank you to all the presenters. Thank you, Marco, for moderating this first panel. And we move on with our agenda. And next is the sponsored speech from CheckSig. Now, let me say that usually at conferences, a sponsored speech is the moment that you eat the restroom or you go for a break. But in this case, we have both today and tomorrow two very brilliant contributions, very centered on the topic we are discussing. And so this is the occasion for me and for all of us, of course, to thank all of our sponsors, Elidata as silver sponsor, Deloitte as gold sponsor, and CheckSig as gold sponsor. And Michele Mandelli from CheckSig will tell us through the challenges in Bitcoin investing for high net worth individuals and financial institutions. Michele, the floor is yours.
Thanks a lot. So first of all, if you don't mind, I will stand so we can just kind of stretch a bit. At least I can stretch a bit. I'll be super brief because I know that I'm the only thing standing between you and the coffee break. So I promise, I guess I don't want to spoil the agenda actually. But, and yeah, as a sponsor, I feel kind of humbled. I'll try to share a bit what we do as CheckSig and what kind of, what kind of innovation we push forward in the crypto industry, and that's why we are sponsoring this conference today. The whole deck is 10 slides. This is slide number 2 already, so I guess this kind of cheers you up a bit. So we've all seen this. 2017, huge narrative, Bitcoin is a fraud, Bitcoin is something used in the dark web, whatever, right? And what we've all seen lately is a huge shift towards a much more investor-friendly narrative, I would say. So these same guys, the head of JP Morgan, the head of the SEC, and the head of the Fed, in 2017 were saying this, and in 2021, they were saying the exact opposite, right? So our clients are adults, if they want to buy it, they can buy it, and this kind of things. We're not going to ban it, don't worry, right? So the effect of this, or maybe the cause of this, has been that there has been a huge surge in demand, especially from high net worth individuals and institutional investors, right? If you see at the investing landscape today, there is a huge demand sitting at the gates, waiting to be able to enter the market. And this is both like individuals with significant amounts of money, but also, you know, large companies, treasuries, institutions, funds, ETFs, so on and so forth. Still, in spite of this huge demand and you know, a more friendly environment, at least a business environment, we see a few challenges for actual Bitcoin investing, especially for large investors. It's just 3 main things. The first thing is simplicity, right? It's really difficult today to buy Bitcoin if you want to buy a significant amount of it. So if you want to buy a few $100, let's say, that's quite easy. If you want to buy 100,000 euro, it gets more difficult. You cannot do it yourself. And you know, in Italy only there is a million, literally like 1 million people that can make that kind of investments. And if you think about Europe, the US, Asia, it's a huge market trying to enter you know, the asset, but just they can't. It's not that easy. And the OTC desks are really designed for much larger tickets, while exchanges are more designed for very small tickets, like small wallets, a few $100. So this is the first big challenge. The second big challenge is custody. So once you've bought Bitcoin, where do you actually keep it? Where do you store it? There was this piece of news on a Spanish newspaper a couple of days ago telling the story of this guy, a founder in Madrid that got kidnapped and he got tortured until the kidnappers actually got the money from his wallet, right? So if you have a few $100, again, it's okay to keep it in your wallet, but what do you do if you have a $200,000 or $500,000 or a few $1 million? It gets complicated, right? Third point is the compliance component of it. So being compliant with the law, especially with tax laws, it's quite difficult. So to solve these issues, we found a CheckSig, which is sort of a bank-like solution. We don't have a banking license, but we would like to have one, actually. And what we do is actually guide our clients through the entire life cycles of making their own investment. So we help them understand what they're actually wanting to enter. We help them buy by executing their order, and we help them, safekeep the assets, and then tax advisory and so on and so forth. But at the heart of this, this has plenty of differentiating components on the European and global market. So we're the only crypto company in Italy that has insurance coverage. We're the only Italian company in crypto that has SOC attestations, and there's just a few in the entire world. But at the heart of this, there's the unique factor is a custody protocol that we claim to be the most secure in the world. And I'm going to focus a little bit on that because that's the most technical part and the most interesting for today's discussion. So what does the technical protocol look like? We have a two-level protocol based on a frozen wallet and a cold wallet. The most solutions usually have a hot wallet and a cold wallet. We have a cold one and an even cooler one, which is the frozen, right? So what happens is that when the customer wants to deposit the money in our custody account, they send the money, the Bitcoin, to the frozen wallet. That wallet is special because the keys to that wallet are not controlled by CheckSig. They're controlled by a federation of 5 independent legal entities, and it's a 3 out of 5 multi-sig wallet. In order to move Bitcoins from the wallet, CheckSig needs to pre-authorize the transaction with a 2 out of 3, and then the federation agents review the partially signed Bitcoin transactions. They check that it's a legit transaction, and they can sign with a 3 out of 5 signature, right? So this means that anything that is into this frozen wallet cannot be moved by CheckSig alone, cannot be moved by the federation agents alone, but everyone needs to agree, and we have different incentives to be honest and make sure that nothing happens that is not, authorized and legit. When the money moves from the federation wallet, the frozen one, it can only go in 2 different directions. One is to the cold wallet, and the other one is back to the frozen wallet itself. This is a very special transaction. We'll get to that in a minute. But let's say that a client wants to withdraw their Bitcoin, right? So we have a transaction moving the Bitcoin from the frozen wallet to the cold wallet. Once the Bitcoin gets to the cold wallet, it is time locked there. It cannot move from there for 4 days. Actually, it's actually a number of blocks, but more or less 4 days. And to move from the cold wallet and go to the customer wallet, right, you need another 2 out of 3 signature with keys that CheckSig controls, right? So in this situation, the money gets withdrawn and sent to the client's address. That's our attack surface, like the only part where we can still be attacked by an external actor, and that's why that's the insured part of our protocol. We have a Cattolic Assicurazione insurance that covers the withdrawal process, right? So as you can see, this is kind of complicated because at the end of the day, we have like 11 keys and they need to work with time locks and covenants, so money can move only towards a specific wallet that is whitelisted, and we have plenty of checks in the middle. Why? Because we're not a wallet. We are a vault for people who have plenty of Bitcoin and want to make sure they cannot get stolen easily at all, right? I was mentioning that we also have a very special transaction that goes from the frozen wallet back to the frozen wallet, right? That's special because that happens, even if we don't have any withdrawal, that happens at least monthly. We sign a transaction and moves all of the Bitcoin we have, consolidates all of the Bitcoin we have, and sends it back to the frozen wallet. Why so? Because the entire protocol is on-chain. So everything is public, auditable, it's on-chain, and that very transaction that redeposits the Bitcoin on the frozen wallet proves that we have a specific amount of Bitcoin in our control, right? So we're kind of showing the world how much Bitcoin we control in any moment in time, right? And you can see that if you go to our website, there's a page, it's an ugly page, but we're fixing that. There's a page that shows you exactly what's happening and how much we have in custody at any moment in time. It's sort of having like a vault, but the walls of this vault are transparent, so anyone can actually see how much is in it, which is kind of interesting, I think. I don't think any bank does that at all, right, with their gold, or Fornox does not do that at all. We actually think that if the big, scandals that we've seen in the crypto industry in the last few years have been basically exchanges that get hacked, we believe that in the next few years we'll see scandals that are custodians that claim they have assets under custody, but they don't. So when you open the vault, you find it empty or not as full as it should be, right? So this is called proof of reserve. Proof of reserve is just a piece of a larger puzzle. If you can prove how much you have under custody cryptographically, and you can prove also somehow how much you own your customers, so what your total liabilities are, then you get something called proof of solvency. It's not proof of stake, no exoteric consensus algorithm here. It's just proof of solvency. We are solvent. We can prove that not only we control this much, but we also owe this much to our customers. So they can, sleep well at night knowing that we're not running away with their Bitcoin. Last slide. So I've been super fast. Last slide. We are a proud member of the COPA, which is the Crypto Alliance. It's an open association of companies, including Blockstream, Coinbase, Kraken, and so on and so forth, that are contributing their patents to a shared pool so that anyone can use freely the technology, and the patent is there just to protect the technology from attackers, right? So we hope and expect that the entire industry of custody will move towards more transparent, protocols, and they might even adopt our protocol as a standard. We would be super happy about that because, again, it's not our own interest. We're not trying to find some kind of sketchy advantage against our competitors, other custodians, but we believe that being open, transparent, having a publicly audited protocol kind of benefits the entire industry. Right? So that's all. If you want to try the service, just give me a call. If you want to contribute, please also do give me a call. I think this part here, the proof of liabilities, it's a very interesting, actually, field of research overall, because it's quite easy, let's say, to prove that you have so much in custody, so that proof of reserve, but to cryptographically prove that you owe that much to your customer, well, that's a much more difficult, if not impossible, task. And that's the edge of the research. And we would be happy to find a way, or if you have any ideas on how to do that. So that's all. Thank you.
So thank you very much, Michele Mandelli. And If there is any question from the floor, yes, there is one. The microphone, please. Oh.
Oh yeah, I'll give you my mic, and then I'll get it back somehow.
Just one thing that I don't understand. You said that for the proof of reserve, you move the bitcoins once a month or something like that. Why you move the bitcoins? You could just multi-sign a message so to prove that you control that address. And it's more secure, right? You don't have to move it.
Yeah, we could actually sign a message or sign a transaction then that it's not broadcast, right? So anyone can actually see the transaction, check that the transaction is good. So that means that we still, yeah. But that would make it actually, yeah, but that would make it more difficult for the layman to check that everything's okay, because you need to check a cryptographically signed transaction, but you can't see the block approved on the blockchain.
Especially if I can jump in, especially if I got it right, because if you have to deal with the multi-signature protocols, like that is complex script, there is no way to provide a simple signature with complex script. So you are...
Oh yeah, you can do that. It's technically feasible. It's just a matter of making it easier for anyone to check it. Yeah. We pay fees, yes, but we consolidate, and we're actually pretty good at paying as low as possible. Oh yeah, we could do that. We could sign a message, but again, it's a good point actually. Yeah.
I think that the key issues will be that if you have a multi-signature involved in the custody, to get the, let's say, you have 11 keys, even just a majority of keys to sign a message, will be very difficult, even for technical people, to assert those keys are the one able to move those coins, especially because the scripts are hashed and so they are not revealed. Actually, the only real possibility to prove that you still own the coin is to move them. But I think we can move the conversation in front of the coffee machine, or anyone at home can take a break. We will be back 20 minutes past 5. Okay, so 13 minutes. I know it's a short break, and at least please, the panelists, get online so we check the connection in the meantime. Thank you very much.
If you want to follow me to the, vending machine, this is the only thing we can offer you, because of COVID restriction, we cannot organize catering. So there are vending machine, we have some money to offer you a coffee or water or tea. Okay, sorry for that.
In the meantime, while we wait, if the remote presenters can be connected and even try to talk and share slides, that will be appreciated.
meet you. Nice to meet you. I arrived a bit late because I got confused in the train station. Okay, everything is fine now. Everything fine. Did I arrive very early this morning? Yeah. Okay. But then I thought it was the Google Map was saying half an hour, but then it took me 1 hour to get here. But anyway, that's fine. That's fine. I hope originally I hope to have much more time on my hands to help you, maybe pick you up. No, that was not. No, it was very today. simple. From the airport to the hotel was really straightforward as you told me. It was really.
Microfono? Sounds good? Okay, ready to start? Sì, it's here. Okay. So, welcome to the second stream on crypto economics, or the third Crypto Asset Lab conference. I'm the chairperson of this session. We have 3 presentations. Let me recall the rules to the presenters. 15 minutes each, and then 5 minutes to the floor to ask questions. Before I give the floor to the first presenter, Michela Rancan, let me thank Digital Gold Institute and the JRC of the European Commission, for helping the university that I'm representing in the organization of this incredible conference. I would also like to thank the sponsor that made it possible, Deloitte, CheckSig, and Edidata, for their contribution, not only monetary, but also in kind, as before you saw and had the possibility to listen to one presentation during this conference. And you also have the possibility to listen to to share the practitioner's view during the conference tomorrow. So let's ask Michela Rancan, our first presenter, to open up her mic and start presenting. I see the screen is already shared, and then we continue our journey in the realm of digital currencies.
Thank you very much to the organizer for this opportunity. This is a joint project with Olli Castren from the European Banking Authority and Ilya Carbonius from the University of Helsinki. And the usual disclaimer applies. So, not much need to motivate a work on digital currency of this work, but just let me remind you that according to a BIS survey conducted recently, more than 70% of central banks are interested in the possibility of issuing a digital currency. And on the private side, we have already several successful initiatives thanks to the adoption of blockchain technology and network effects. But of course, the new opportunities that digital currencies brings also create some risk and threats to financial stability. So, of course, this is a topic of great interest also for policymakers. Okay, so what we do in this paper is to introduce digital currency in the euro area financial accounts using a network of the macro sector, the institutional sector of the economy. And specifically, given that we do not have much time for the presentation, I will focus on the case in which central bank issue a digital currency. And the main focus of the paper is on the associated risk, mainly for banking disintermediation and the other funding constraints that this causes for the other sectors of the economy. And to do that, we take advantage of the network effect, which capture third parties' effects and the dynamic of rebalancing the accounts. I skip the literature and I go straight to the model, to our framework. In our framework, we have n institutional sectors that I will describe in the next slide. And each sector has a balance sheet with asset A and liabilities L. On the asset side, there are equities, debt, specifically deposits, debt securities, and loans, and other items. On the liability side, we have again equities, debt position, other items, and net wealth. That is the difference between the asset and these three elements. So for each sector, the balance sheet has this structure, and at the system level, there is also the sector called rest of the world, that is any type of transaction done with foreign parties. And this characteristic is important so that the net wealth globally for the system is equal 0, which means at the end that every asset of a sector is a liability for some other sector. And this is also the structure of the data that we use, which are the euro area accounts, data produced by the ECB, which group together economic agents which have which are homogeneous. So as sectors, we have households, non-financial corporation, banks, central bank, insurance companies, pension funds, other financial intermediaries, investment funds, general government, and the rest of the world. And these 10 sectors are the nodes of our network, and the links are the who-to-whom information that we have from the euro area accounts data for each instrument categories that we saw before. So deposit, loan, debt securities, and so on. So in this graph, I draw the network for a specific point in time. On your left side, this is the network of deposits. So the green node, the yellow nodes are the 10 sectors of the financial system. And you can see that this big arrow is the exposure of the banking sector toward households. And this is the largest arrow because the main counterparty in terms of deposit for the banking sector are households, followed by the rest of the world and non-financial corporation. On the right-hand side, I draw the network for debt securities. In this case, the network is much more complete because almost each sector issue bonds and holds the bonds of some other sectors. So, in this framework, we introduce the digital currency. And as I said, I focus on the case of CBDC, but our framework is flexible enough to consider also the case that also a stable coin is issued by a private entity. In time t, we assume that the digital currency is issued by the central bank. And in time t plus 1, a shock epsilon that takes the form of a switch withdrawal of deposit by households and non-financial corporation from MFI to the central bank, which hosts the digital currency. So the liability side of the MFI sector shrink. So the deposit is reduced by this amount. On the other hand, the liability side of the central bank will increase by the same amount. So here is just a representation of what I described. This was the status quo before introducing any shock. Then you have these two arrows on light blue that shrink, while the dark blue arrows that goes from central bank to households and non-financial corporation increased. Here I was doing a simulation with a quite small shock. And then in time t plus 2, the sector issuing digital currency, namely the central bank, has several options. One is to redeposit the amount on MFI sector. Another option is that it can buy bonds with that amount, while the option for MFI, in the first case, it's the fact that central bank redeposit the amount doesn't create any funding gap for the MFI. But if this is not happen, then the MFI may do some other action. One option is that the MFI sell debt securities. Another option, option 3, is that MFI redeem some loans, or finally, it may also issue new bonds. So this is the general framework, and then we see some impact, economic impact of what I described. First of all, we focus on the funding gap that the shock creates for the banking sector. So in case we consider a shock equal to 20% of households and non-financial corporation deposits, this corresponds to a 9% reduction of deposits for the commercial banks. And of course, if we implement a bigger shock, the funding gap for the commercial banks become larger. This is important because deposits for commercial banks are the most stable and cheaper source of funding. Of course, if we consider the case in which central bank redeposits the funds with the commercial banks, this funding gap eliminates or is substantially reduced. However, the case in which the two, completely the redeposit is complete is not really realistic, because central bank repo need to be collateralized and would be more expensive for commercial banks. Another consequence, in case we consider option 2, is a substantial repricing on the debt market, on the debt securities market. This would depend on the fact that central bank preferences for bonds are different with respect to commercial banks. So in option 2, central banks choose to buy bonds, while MFI choose to sell bonds. And they do, we assume, according to their existing preferences. But the fact that, for example, MFI would sell a smaller amount with respect to the amount that the central bank would be willing to buy for government bond, this would create upward pressure on prices. On the other hand, for other sectors, this would create a downward pressures on prices. And this is the case for the MFI sector and the other financial institution. Concerning the other scenario, in option 3, we have the MFI that redeems loans to offset the reduction in its deposit liabilities. And this, of course, would create some constraints for all those sectors relying heavily on bank loans, such as households and non-financial corporations. And then the question would be, what could be the alternative source of funding for this sector? And what could be the central bank intervention? An alternative scenario is the one in which MFI issue new debt, new bonds. However, again, the central bank preferences for bank bonds is not so strong according to the current portfolio. So then, in case the banking sector would be able to issue all these new bonds, the point is who could buy this large amount. So, whether we apply one scenario or the other or another, the effect for the funding opportunities for the other sectors and for the banking sectors seems limited. We also conduct different analyses based on the size of shock, on the source of the shock, and the severity of the impacts depends on the different hypotheses that we do. Moreover, the introduction of a digital currency heavily affects the network structure that I show you, with the relative importance of the different sectors changing substantially. Another feature that we cover with our framework is that as we use the euro area accounts data, we conduct the analysis over the period 2015-2021, and of course the effects that we document also change over time. And finally, as I said before, our framework is flexible enough that allow us to consider also alternative design, like the introduction of a digital currency by a private entity, an investment fund, or to locate the stablecoin initiative issuer in the rest of the world as a foreign entity. I have done.
Thank you. Thank you. It is a very topical issue, how to design digital currency in general. It is, in the agenda of central banks, but not only central banks. Now we understand why the ECB is planning 2 years period of study to define how to design the digital euro. If we were not fully aware of the disruptive effects of such a digital currency, now we are. And thank you for the explanation. If you go through the paper, you will see all the details of these disruptive effects, especially on the banking system. I have a questions, but before I would like to see whether from the floor here in Milan or online, possibly questions. Otherwise, I'll go through with mine. Oh, it seems that I can do first. In your paper, you have a choice between 3 different types of issuers, as you said, the central bank or a private issuer or the rest of the world. And following, and I just had the opportunity to read one of the governors of the Fed speaking about the central bank digital currency, and you referred to them as a solution in search of a problem, meaning that there is no need to issue such a currency by the central bank because we can just rely on the market to fulfill this need for a digital currency. Do you agree with this? And then in your model, is there any way that we can say there is a preferability from a digital currency issued by the central bank, given the effect on the banking system, or is there any preferability of digital currency issued by the private sector located in the country or outside or in the rest of the world?
It's not an easy question. I mean, it's a big question. I think, there are, I didn't have time to explain, but there are really several details concerning how a digital currency would be considered also from a monetary policy. For sure, the option of the digital currency issued by a central bank would guarantee somehow a solution that from a policy perspective could be maybe governed, managed more easily with respect to a solution by private and decentralized, maybe abroad issuers. And concerning the impact in terms of financial stability, I think our analysis gives just some insights, but I think they could be even more disruptive.
Thank you. Yes, sorry. We need to move on because time constraint is biting. And so we go with Sam Werner and his colleagues. Now we enter in another dimension, that of decentralized finance. So we leave central bank digital currencies. And then these authors will help us to discover the essential feature of DeFi and understand the problems. And I must say that I will follow their presentation with very carefully, since I think we need to, soon we will need to explain or to dedicate at least one lecture in our university classes to this topic, not to leave our students unprepared to what the financial ecosystem is now offering to them. So please, Sam, can you share your screen and open your mic, and the floor is yours.
Yes, can you hear me?
Yes, we can hear you, but we do not see you.
Can you see my screen?
Your presentation, yes.
Great. I'll take it away then. Thank you very much. Thank you very much for having me. I'm Sam. I'm a PhD student at Imperial College London, and I will be presenting a paper that I recently worked on, a systematization of knowledge on decentralized finance or DeFi, which is joint work with Daniel Perez, Louis Gudgeon, Aria Klagesmuth, Dominic Hartz, and Will Nottenbelt. And in this presentation, I will first talk about briefly what DeFi is, before diving a bit more into what DeFi primitives we have and need to build different types of DeFi protocols, and then also looking at the security in DeFi and sort of how we can assess it before at the end briefly touching on open research challenges. I'll try to cover everything, at least to some degree, that we've also touched on in the paper. So this outline is pretty close to what we did publish in the paper. So afterwards, of course, I can only encourage you to have a look if you're interested in more of the details. So first of all, what is DeFi? So in a nutshell, DeFi is, well, decentralized finance is a peer-to-peer powered financial system that is built on blockchain technology. And in an ideal world, there are 4 properties of DeFi. So DeFi should be non-custodial in the sense that participants have the full custody over their funds at all points in time. So it's unlike a traditional bank that acts as a custodian in centralized finance. DeFi should also be permissionless, where anyone can interact with different services without being censored by any external party. And DeFi needs to be auditable. So we need to be able to verify the on-chain state of different applications. For instance, if we want to verify that there is enough collateral posted as part of a lending protocol which issues over-collateralized loans. And lastly, which is one of the most interesting aspects, is this composable element. So financial applications in DeFi, they can be arbitrarily composed, so they can be plugged into each other. Almost, you can think of it as money Legos. And this is really what DeFi is. So if we think about it, we could have 2 different views on DeFi now, right? We could have the DeFi optimist, and we could have, on the other end of the spectrum, the DeFi pessimist. So according to the DeFi optimist, DeFi is the future of finance, right? Paving this way that extends on what was introduced by the Bitcoin white paper of non-custodial transaction and actions, and really allows them now to allows us to use them in these complex financial applications that we build, and thereby shape the future of finance. On the other hand, we have the DeFi pessimist, who's very skeptical of this entire DeFi bubble almost in their world, and the pessimist views DeFi as this ecosystem that now facilitates not novel financial services, but new ways to launder funds, and even allow now any scammer or any scammer to earn interest on their laundered funds. So it's a tough decision, but we have to decide on what's the correct view here, and it's complicated, right? So it's very difficult to say at this point now who's right and who's in the wrong. So let's look into this in a bit more depth, right? So let's start with the DeFi primitives and the different protocol types. So the DeFi primitives, it's really what we need to be able to build these DeFi applications. And the first thing are smart contracts and atomic transactions. And before diving into this in a bit more depth, I just want to note that unfortunately, because of the length of the presentation, I'm unable to elaborate on the sort of specifics of the underlying ledger. But we're just touching on the high level components here. But yes, so we need smart contracts and atomic transactions. So smart contracts, essentially these objects that live on the blockchain that can communicate with one another, and then atomic transactions, so where transactions either succeed or fail entirely, so that we don't end up with semi-updated states. And next thing we need is our keepers, which are these external agents that are needed to ensure the correctness of applications to work by triggering some on-chain states. So for instance, by reporting to a smart contract that a loan is liquidatable. Then we need oracles. So there's a lot of information that's off-chain that we don't know about on the blockchain. So we need mechanisms to import this off-chain information onto the chain. For example, price feeds. There's no way to know what certain assets should be priced at on chain. And lastly, we need governance. We need a mechanism through which a system is able to evolve over time and update parameters, add new parts of the protocol. And an example of this would be, you may have heard of them, the governance tokens. So essentially tokens where the token holders are allowed to vote on these sort of updates through some on-chain voting mechanism. And if we have these primitives now, we can sort of look at this breakdown of DeFi. I mean, I hope it's not too small, but I can briefly walk you through it. So at the top, we have our distributed ledger, and then we have smart contracts. And if we have smart contracts, we can essentially implement tokens, right? That's what's needed to implement tokens. And, with tokens, and smart contracts, we can now, if we add some governance mechanism to it and some oracle for off-chain data and add a market mechanism, for instance, liquidations and collateral, we can start building different protocol types. And then we can leverage the composable element or nature of DeFi and plug them into other existing protocols. And on the right-hand side, we're sort of left with these six unique protocol types in DeFi. And I will just briefly now touch on each of them and give an overview. So the first one, the first protocol type is on-chain asset exchanges. So an example are decentralized exchanges, which rely on traditional order books, but more popular in DeFi are automated market makers, which essentially pool liquidity for different token pairs in a smart contracts and in a smart contract, and anyone is able to trade against a smart contract's reserves. And as the balances change, the prices changed as well, but can be determined deterministically. And this is one key element of these protocols. Another example of another protocol type are protocols for loanable funds, or so-called PLFs. And they are essentially lending and borrowing protocols. So protocols that create markets for loanable funds where anyone can borrow against the smart contract reserves. There is an interest rate that is determined algorithmically by the smart contract as the utilization of funds changes over time, and the loans are over collateralized, meaning that if collateral to debt ratio changes too much, they can essentially the borrowers can be liquidated, and the protocol is protected from suffering losses. And then we have stablecoins, which were mentioned before in other presentations. Stablecoins, of course, extremely important for DeFi to be able to have this pegged to some target currency, typically the US dollar. And the core components of stablecoins, we have collateral, endogenous, implicit collateral, different forms, agents, so the agents that post collateral, and of course the stablecoin users. We have a governance mechanism, we have some control mechanism with regards to the issuance of the stablecoin, and we also rely on oracles here. There's a great paper on stablecoins 2.0, can highly recommend it for more depth. Portfolio management, another big application protocol type in DeFi, protocols essentially that encode different fund allocation strategies in the smart contract itself. This can be done anything from rebalancing a portfolio to so-called yield farming that allocate funds, essentially strategies that are encoded in a smart contract that allocate funds in a sort of an optimized way to maximize returns across various protocols. And then lastly, we have derivatives, which I don't need to say much about. Very, typical, very important in the traditional financial system. Also exists in DeFi. See more and more adoption, and then privacy-preserving mixers are also a big one. It's essentially ways that allow us to preserve user privacy, which I guess in one way can also be seen as a controversial topic, but definitely a core component of DeFi that can be included by itself, or I guess by including the mechanism of how these funds are mixed through, I guess, general mixing schemes, or by leveraging zero knowledge proofs, or they can be used as individual protocols. So these are essentially our protocol types. And then we're now at this point where we should discuss security, because that's, of course, one of the most critical aspects of a financial system, if not the most critical aspect, because we cannot use it if it's not secure. And security it's quite a difficult one in DeFi, because we can essentially break it down into two different types of security. We can break it down into technical and economic security. And what do I mean by technical security? So technical security, we define it as this atomic instantaneous exploits of technical structure that can be done risk-free, that fall under technical security. And what we're really trying to say here is that these are exploits that an attacker can perform within a single block. So if you think about it, if an attacker is able to perform an exploit in a single block, there are two outcomes. Either the attacker is successful and the profit is made, or it just doesn't happen and the attacker is, I guess, the attack fails, and there's usually just the gas cost left to pay. And examples are minor extractable value, reentrancy attacks, of course, simple logic bugs in smart contracts. But these are all really issues that can be addressed through existing, program analysis tools, and they have been studied quite well over the past, 3, 4, 5 years. So this is actually, these are different attacks that we already know quite a lot about. So, right, smart contract vulnerabilities are quite obvious. Okay, at least the topic itself. There's more and more work being done there to control them and be able to analyze and mitigate them. Then we have single transaction attacks. So essentially attacks that can be performed in a single transaction on Ethereum, for instance. This would include governance attacks, where you could think about a user borrowing a lot of governance tokens through a flash loan. So flash loans essentially are loans in DeFi where you can borrow as many funds as you want, almost within a single transaction, as long as you pay them back at the end of the transaction. So you can borrow a bunch of governance tokens and then use them to vote on some malicious decision in a DeFi protocol, and thereby attack that protocol in a single transaction. This has been done before, has been seen before. You can take a flash loan to manipulate the balances in an automated market maker, which may be used as a price oracle by some other protocol, and then exploit that. So it'd be this sort of sandwich attack where you're manipulating a price, then exploiting a protocol, and then rebalancing the price, and then repaying the loan. This has been done numerous times in DeFi. And then the last sort of category of technical security attacks would be transaction ordering attacks. So we would have either displacement attacks, where we can think about if you have multiple transactions and you have sort of one victim transaction that you're trying to target, where you just where the success of the attack is just dependent on your transaction being inserted before this victim transaction, right? So if you think about if there's a transaction that buys a particular domain and you're able to buy this domain before that other transaction goes through, then it's regardless whether that other transaction goes through afterwards, because it will fail once you've managed to buy the domain before. So these are displacement attacks that we see in DeFi. And we also see multiple transaction sandwich attacks. So essentially, attacks that require multiple transactions by the attacker that come before and after a victim transaction. And these, unlike displacement attacks, then depend on both transactions of the attacker being executed successfully, or else the attack will not succeed. So again, one example would be manipulating the price in an AMM, a user, then the victim transaction doing a swap at undesired prices, and then the attacker would rebalance the AMM and make a profit. But more interestingly is really the economic security side of things, where it's really a matter of manipulating some incentive structure in a protocol over a longer time period. So essentially attacks that cannot be executed in a single block, but take multiple blocks to exploit. And this process is not risk-free. So that's the main difference to technical security attacks, because here there's this upfront cost to an attacker to manipulate these incentive structures. And these attacks are extremely less studied. There is minor extractable value, so essentially the value that a miner gets from being able to order transactions, censor transactions, or even insert their own transactions in a block, which can result in reorganization attacks of the blockchain. There's governance extractable value, essentially the value that one can get by making decisions in one's own interest and not the interest of the wider protocol community. And this is something which needs a lot more research, especially we need economic models to really look into this and how these systems work in different scenarios and equilibria. So just briefly, we identify really three key categories of economic security attacks. So as I mentioned briefly, we have minor extractable value, because in DeFi there are many sources. So there's arbitrage that can be performed on decentralized exchanges. There are liquidations that a miner could, front run. So instead of if someone calls a loan to be liquidated, the miner could do this instead and sort of front run the transaction. So this paves the way for various avenues that can be exploited. Then we have governance extractable value, what I touched on briefly. And then we have market and oracle manipulation, right? Which is quite an interesting one. We have this difference, when you hear this term market or oracle manipulation, there's a clear distinction to be made here, because we have the market that can be manipulated, where essentially because there's thin liquidity or for other reasons, an attacker is able to manipulate a market, and the oracle correctly reports that price of the manipulated market, which may result in an exploit in some DeFi protocol that relies on this price, versus we could have an oracle that's actually manipulated by bribes being made to the centralized oracle operator, or the oracle being exposed to some other type of game theoretic attacks. So the oracle is actually manipulated, but not the market. And these are essentially, this is really what leads to different open research challenges. We have composability risks that we are still not able to quantify well, if at all. We have, for governance, models that we need. We have initial work done on it. I should say with we, I'm speaking for the community here. So the community, there is work being done, but it's still in its infancy on this side. Same goes for oracles, how to structure and maintain incentive compatibility over time. Minor extractable value is a critical point, especially again coming to quantify it a bit more. What are the negative externalities? And also program analysis is something that, yes, there's a lot done in detecting bugs in smart contracts, but if you look at the sort of exploits over the past 24 months, that doesn't, I guess, indicate that program analysis tools are working extremely well in DeFi. And then lastly, anonymity and privacy is an area that is still quite understudied in DeFi, I would say, and should deserve more attention. Yes, thank you very much. I hope I wasn't overrunning too long. Again, I realized there were a lot of points that I touched on here. For more details, we extensively discussed this in our paper. So if you enjoyed it, feel free to reach out or have a look at the paper. Thank you.
Thank you, Sam, and thank you for your thorough description of DeFi. I apologize for not letting the floor to ask you question because you used all your allotted time, but I wanted you to use it because you were doing a very useful presentation. I remind that this is, I think it is this beginning of your PhD thesis, PhD program, and so I urge all the participants to contact you to discuss the challenges that you have sketched out at the very end of your presentation. These are very challenging questions that we need to face and find a solution. So please, all the participants, myself included, will contact you and thank you for participating to this conference. And as a matter of fact, you gave me the idea that next year, Ferdinando, we will have a special session for PhD students, just for them. Okay, thank you very much. And now we move to Georgios and his paper on financial literacy and attitudes to cryptocurrency. So we move to another realm dedicated to financial literacy. Here the idea is to understand the demand for and the characteristic of the demand for cryptocurrencies. I think it is a timely study because notwithstanding the complexity of cryptocurrencies that we understood through all the presentation of this afternoon, these are quite an easy token to be bought, at least in small amounts, as Michele showed us. They are easy to be bought by the general public, and as they will show us, they are unsophisticated investors. So please, Georgios, if you can share the screen, and yes, you already shared, and then the floor is yours.
Thank you very much. Thank you, Paola. I hope you can hear me and see me okay.
Yes, perfectly.
I'm on my screen. Great. Thank you very much. It's a pleasure to present at the Crypto Lab conference, and this is joint work with an excellent PhD student at the University of Glasgow, Tatja Karkainen, and Adele Atkinson, who was formerly at the OCT, and at the moment I understand she's taking some time off, working privately as a consultant. So I will try to summarize within 15 minutes the motivation and the findings basically of the study, which is kind of a straightforward study, although the results were not so much necessarily expected by either us or basically the people in both communities. I'm guessing it's a merging of two literatures, growing literature on financial literacy, its determinants and its consequences, and then the literature on the demand side for cryptocurrencies, which is relatively newer and even more small, if we wish, or smaller. So for some reason, results might have been expected to the people in the financial literacy community. Probably they were less expected by the people in the cryptocurrency literature. Now, obviously, these are challenging times for managing personal finances, and I believe I don't need to explain why. I will just mention the changes in financial markets and the financial technology. Obviously, before the crisis, there were many more opportunities for liquidity, financial inclusion, and more opportunities. The crisis of 2008 created its own limitations. Obviously, financial technology by the year 2021 and in the last 4 or 5 years, where it has experienced dramatic growth, creates new opportunities for liquidity, for inclusion, and potentially many other good things. However, it entails the challenge of increased complexity, and that can be further perplexed by dimensions of financial illiteracy and even digital illiteracy, which is an additional component of complexity. Other than that, we have, of course, all the changes in the pension markets, the labor markets, the political sphere, and COVID-19, as if it wasn't enough. I keep on adding to this list of potential complexities for managing personal finances. So as if this wasn't complicated enough for the management of personal finances in modern times, we have the fintech era with potential, of course, a lot of solutions. But also likely complexities, particularly for some key demographic groups that might be less used to using digital solutions. Now, interestingly enough, if we are to sort of go back and think about what could be the potential triggers of the fintech revolution, among the potential triggers, one would clearly see the inception of a certain cryptocurrency called the Bitcoin in 2009, which, no matter if one likes cryptocurrencies or not, we can sort of be certain that this was a turning point for the financial world. And obviously, ever since, investment in fintech has shot up by many, many billions of dollars. Now, when we started writing this paper, or when we started getting the data for this paper by the year 2018, there were some 1,800 cryptocurrencies with a market cap close to $300 billion, which is approximately the size of one of the top 12 S&P companies. As we keep on revising this paper and get asked by referees to do extra tests and extra things, within a couple of years, the number of cryptocurrencies was, the last time I checked, 5,392, and I'm pretty sure there's plenty more at the moment, as the last time I checked was a couple of months ago. Bitcoin is the largest cryptocurrency, which accounts for around half of the total market cap, basically. There are some 300 crypto funds in that market that have emerged. These are like hedge funds that invest solely in cryptocurrencies, attracting around 10 billion in assets under investment. At least that was a review in a good paper published by Rooney and Levy in 2018. At least half of them are active crypto funds, according to PricewaterhouseCoopers, with the rest being trackers, basically. So we also have the development where the Bitcoin futures commenced trading in 2018, catering to institutional demand for trading and hedging the Bitcoin. The volatility pictures for the Bitcoin, I'm pretty sure you are all familiar with, and you can guess that with the price increases and decreases that we have witnessed through time, there's a great amount of volatility in that market compared to most of the other asset classes like real estate, the stocks, gold, government bonds, and cash, obviously being the least volatile. That volatility, its lowest points compares to that of stocks, but there are times in which it becomes great. And that essentially is for the years 2016 to the beginning of 2019. That picture can be extended and volatility continues. Volatility compared to currencies, national currencies, is also showing a similar picture, with the Bitcoin being a really volatile, instrument compared to most other currencies. Its volatility can only compare to that of the Turkish lira in recent times and in the recent past, at times in which the Turkish lira was really either declining by a lot or trying to recover basically from a heavy decline. So obviously, we know that central bank heads, such as the Bank of England's head, have publicly expressed concerns about cryptocurrencies, and we have seen many, many more. Now, the one really influential paper in this literature that was among our points of motivation is one by Foley and his co-authors at 2019 at the Review of Financial Studies, where they managed to basically match transactions done using the Bitcoin without breaking the anonymity of the users. They just managed to match IDs, basically using some very sophisticated methods. And their estimate suggests that around 76 billion of illegal activity per year involves the Bitcoin, which is around 46% of the Bitcoin transaction. That figure is close to the estimated scale of the US and European markets for illegal drugs. So obviously, apart from the concerns that cryptocurrencies might facilitate things like the essentially trade of drugs, hacks and thefts, illegal pornography, and even murder for hire, along with terrorism, money laundering, and the avoidance of capital controls, we have a certain estimate that suggests that around half the size of that market, essentially using the Bitcoin, involves illegal activity. Of course, outside the academic literature, there are more pieces, but mostly from crypto enthusiasts, suggesting that those figures might actually be smaller or much, much smaller. The point being, the paper by Foley at the RFS is the only academic work of basically by some high caliber academics that I'm aware of, that estimates a very large magnitude for illegal activity. So components in the market so far: sophisticated crypto funds that invest solely in cryptocurrencies and they operate like hedge funds, and a big part with illegal activity. In this paper and in this work, after this bits of motivation, we are interested in the remaining segment of the market, the third segment of the more everyday type of users in the population. And we try to figure out the characteristics, the determinants, if you wish, of the demand side for cryptocurrencies. So we're interested in who buys cryptocurrencies and who's interested in buying them. In order to examine the demand attitudes to cryptocurrencies, we are using microdata from 15 countries from a certain survey conducted by the ING. It's called the ING Global Banking Survey. Our first effort in basically examining whether those who are more likely to buy cryptocurrencies are more or less financial literate, we generate a financial literacy proxy using data from the S&P 2015 Global Financial Literacy Survey, and we construct a composite index based on country scores overall and by gender, age, and income groups. Then we're interested in examining the relationship between financial literacy and attitudes to cryptocurrencies in terms of owning, intending to own, not intending to own, and not having heard of cryptocurrencies. So 4 types of attitudes towards them: owning them, intending to own them, not intending to own them, and never having heard of them. Of course, because if you wish, our initial point of departure involved the generation of an external proxy for financial literacy. In order to be able to complete and sell the paper, we needed to document the external validity of our instruments. So we partnered with our third co-author in the OSCT, and we created a custom survey that was applied in 3 Asian countries, as this was where the opportunity to create our own survey was. And we use an additional survey from 3 more countries, from retail investors there, a little bit more of a selective audience of investors. That survey was named the OECD Consumer Insights Survey on Crypto Assets. And we tried to see whether our main results hold in a completely separate sample, that we had the opportunity to create proxies for both attitudes to cryptocurrency and financial literacy, which was, if you wish, the caveat of our primary sample. In the second moment, or in the second part of the paper, we attempt to identify the moderating mechanisms in the relationship between financial literacy and attitudes to cryptocurrency. If these are explained, if you wish, by technological literacy or illiteracy, by age, if the cryptocurrencies are liked more by younger individuals, financial advice and or imitation, attitudes to informality, and then our favorite explanation, which has to do with perceptions of risk and reward. I will not bother you with the literature on financial literacy. Obviously, financial literacy has become a separate GEL code, a separate code in the Journal of Economic Literature. There's many papers showing that it is related to a number of desirable, if you wish, financial behaviors. Cryptocurrencies have never been examined much from that, the viewpoint of that literature, but in a very early cryptocurrency paper by Glaser and his authors in 2014, the authors report finding strong indications that especially uninformed users approaching digital currencies are not primarily interested in an alternative transaction system, but seek to participate in an alternative investment vehicle. Now, in terms of our research question or hypothesis, we're wondering if we should expect the financial literate to be in favor or against cryptocurrencies such as the Bitcoin. In the literature, one can find elements that would suggest both yes and no, basically. So if the financial literate are more likely to invest and have a more diversified asset portfolio and to obtain higher asset returns, then potentially they could and should be interested in more cryptocurrencies. On the other hand, if the financial literate are better positioned to evaluate risk, control sentiment and related urges, then potentially the answer could be no. Based on the financial advice and imitation literature, depending on the interpretation, the answer could be yes or no. So in reality, we don't have any prior suggesting a specific relationship. There could be basically explanations for finding both a positive and a negative relationship. Now, our primary survey, the ING, entails basically convenience samples with weights that are aiming to make them nationally representative of around 1,000 individuals, for a total of some 14,828, primarily from European countries, some Eastern European countries, Turkey, the US, and Australia. So we're trying to use a sample that's as close to global as one can claim to have with convenience samples. Now, in terms of the figures, we get figures of around 9%, 8 to 9% cryptocurrency ownership around the world. So some 9.3% in our sample, in our weighted sample, own cryptocurrencies at the moment. There's an additional 14% who intend to own, 40% that does not intend to own, some 34% that has actually never heard of cryptocurrencies before. There are some interesting differences between countries. So, for instance, the highest figure for ownership is from Turkey with 17.7% cryptocurrency ownership and a more positive inclination towards intending in the future, which in part can be explained also from the volatility of the Turkish lira in recent times. Other countries with high figures involve Romania, Poland, and Spain being above the 10% threshold. So there is a certain pattern for countries that have their own currencies outside the Eurozone, and Spain, for some reason, having a high figure. I mentioned that our financial literacy proxy stems from another survey, at least in the first and primary sample. Our proxies basically involved match scores of individuals based on their gender, their age, and their income group. And then we create also proxies that remove any country-level differences in order for our proxy not to be affected by the fact that in some countries the population tends to be more or less literate. The relationship, which also tends to largely hold in our regressions that will follow, could mostly be summarized by this figure in the primary sample. There is a negative relationship, mild negative relationship between financial literacy and the probability to own cryptocurrencies. This is just using the country score, so without even going to the more individual-based proxies.
Georgios, you're running out of your time, so please
I will summarize. Yes, negative relationship with the intention to own in the future, and then essentially mild positive relationships with no intention to own. This is the second survey, as I mentioned, from Malaysia, the Philippines, and Vietnam. I think I can basically just show you the primary result, and I think this summarizes the pattern of what we find. Our regressions using the more individual-based measures find that financial literate individuals are some 40% less likely to own cryptocurrencies, some 23% more likely not to intend to own them in the future. So the financial literate seem to be less likely to currently own them and more likely not to intend to own them. To keep a long story short, that pattern holds in a battery of robustness tests. It also holds in the OECD survey, in which we also have a financial literacy proxy that is from within the same sample. The magnitude of the effect is roughly the same, 40% less likely to own cryptocurrencies. Among the candidate explanations, the one moderator that seems to destroy the relationship we find is the perceptions of risk and reward. It's not age, it's not digital illiteracy, it's not all the other things that we seem to basically try to find as the moderators. Long story short, and as a conclusion, as I'm usually terrible with time, the regulators are right to be concerned regarding the demand side for cryptocurrencies. We find that our evidence complements recent literature suggesting that there's a large volume of illegal transactions and a few sophisticated players. The bigger segment of that market, or the segment that entails more individuals, seems to be dominated by largely uninformed traders. That might be explaining the very high volatility of that market. And in order for that market to become an alternative instrument that is established, efforts could potentially be driven towards disseminating information in a more transparent and clear way, and ensuring that there's some type of training of the users to whom these instruments are available. Thank you very much, and apologies in case I overexceeded my time.
Thank you very much. I know that there is a question from Ferdinando. I have plenty, but I think I will be writing to you all my questions and suggestions, because financial literacy is my bread and butter, and I really enjoyed reading your paper.
Professor Panos, I do appreciate your approach on connecting financial literacy and attitude toward cryptocurrencies. And I think it's evident in some sense that the idea of becoming rich soon, which is very popular among especially uneducated people, is a good sign of attraction for cryptocurrencies. But I will also say that the lack of understanding of cryptocurrencies by people with traditional financial literacy shows that traditional financial literacy might be severely lacking and into understanding the event and the phenomena. And I don't want to be picky on some numbers that you present, like, you know, the number of cryptocurrencies or their capitalization, which are off the mark, but like volatility. I mean, volatility is recognized on the market to be the price of the return. If you want high return, you have to experience high volatility, and so it would have been much more fairer to compare, let's say, Bitcoin to Tesla, Amazon, Netflix, or Apple, the best performing asset of the last decade that have been providing returns comparable to the one, let's say, of Bitcoins, and volatility comparable. So wouldn't that be a much fairer comparison? And secondarily, I mean, 46% of transactions being illegal is completely at odds with evidences from forensic companies like Chainalysis and Elliptic, which say that illegal transactions are less than 1%. And again, I mean, even illegal uses are not something problematic per se. The US dollar is notoriously used by drug cartel. Terrorists use internet and flights to take down skyscrapers. So, but we do not banish, you know, internet or flights or US dollars for that.
Mm-hmm. Well, thank you. They're all good points. I mean, you would need to explain to me why you think that market capitalization is off the mark. I think the figures are accurate for the period to which the data is related. If they're off from today, then on that we can agree on, because today the figures might have changed. But for 2018, 2019, I do believe the figures are the ones that are right. Now, regarding the need for the financial literacy curriculum to turn into a more digital-based one in order to be able to really train or prepare people for the use of digital products, not just cryptocurrencies, but also other digital products, I also find that you're absolutely right that curriculum does need rejuvenating and basically improving. Now, digital literacy per se is one of the moderators that we test in the paper, and although we find it is relevant to attitudes to cryptocurrency, it's not the one that explains the relationship that we find with financial literacy. So, although in practice I do believe that the two should be combined, on its own, technological literacy or digital literacy does not destroy the independent effect of financial literacy. Now, regarding the figures for the illegal markets, I have also seen the evidence that you point out to with 1%, but to me, this is not academic evidence. This is more evidence stemming from crypto enthusiasts. So if you, as an academic, you ask me who I trust more, a paper at the Review of Financial Studies or a paper by essentially somebody who trades cryptocurrencies for a living or who basically is a big part or an enthusiast of that market, I will prefer to trust the academic methods and sources more. If there's an academic paper that suggests otherwise, I'm happy to review the method and concur. I did mention that even if it's an overestimate, it's a good indication of what's happening in that market. So I think these are the points that I noted from your question, but if there's anything that I left out, please feel free to let me know.
Thank you. There is another question from the...
Just to point out that you don't need an academic paper to evaluate how much cryptocurrency or Bitcoin are using the dark.
No, yeah, I think he doesn't hear you. So.
Sorry, no, I mean, it's just that there are very simple facts that you can check by yourself just going to the dark web, and you won't find any offer in Bitcoin, because Bitcoin is a traceable cryptocurrency. So all your data of 79 billion using the dark market are completely offline. It's absolutely false, and you can check it by yourself. Just take a Tor web browser, and you go into the dark market, and you check by yourself how many offers are in Bitcoin.
I mean, I did take the point, but as I said, it's not actually my data. The estimate is from Foley and his co-authors.
You can check in 5 minutes.
I'll be happy to, but again, if there's a note for correction that needed, is that the paper by Foley is published in 2019, so probably it might be referring to data of up to 2018. If something has changed today, then I'm happy to include it as a note, but it's an academic paper I'm citing. It's not really my estimate by people who published it at the top, so I don't really debate it. I'm just citing what others published, basically.
Yeah, but the issue is not the relevance of the number of illegal use of Bitcoin, is that there are lots of transactions out of this that are among maybe uninformed traders. But then, thank you very much, Georgios, for your presentation, and I'll send my comments via mail. And I leave the floor to Daniele Marazzina, who is going to be the next moderator for the third session stream of this conference.
Okay. Thank you to the organizer. Thank you for asking me to chair this session, and welcome to our quantitative modeling section. We will have two talks, but first of all, let us thank the organizer and the sponsor, gold sponsor like Deloitte and CheckSig, and the silver sponsor like Elidata, to make this possible, to make this third conference on cryptocurrency here in Milan. So we will have two talks. Both talks will be online, and the first talk is from the group of Pavia. Paolo is online. Paolo, are you online?
Yes, here I am. Okay. Hi, everybody.
So here we have Paolo Pagnottoni from the University of Pavia, which will present a talk on sentiment, Google queries, and explosivity in the cryptocurrency market, which is a joint work with Arianna Agosto and Paola Cerchiello. You have 15 minutes, and so if you can share the screen, the floor is yours.
We think we are mute.
Yes, now
okay, yes, I realized now I was mute. Okay, sorry. I just share my screen. Do you see? Says I'm sharing.
No.
Sorry, it froze.
Are you sharing? Do you feel like you're sharing your slide because we don't see them?
No, it froze WebEx. I'm using the application as suggested, but it froze. It's okay, now it okay came back. Sorry. Maybe it's because too many applications open and he doesn't. Let me try. I try to close something. Check.
Otherwise, maybe we can share your slide from here.
Yes, if you have, that would be nice, because I'm sorry, but I don't know why we checked today and it worked.
Lucia, can you share
sometimes, as you know, it freezes every time I try to. Okay, maybe now it works. Huh? It says me I'm sharing Lavand.
Always missing.
The blackboard. Can you hear me, see me?
Yes, I can hear you, but we cannot see the slide.
Not the slides. He tells me I'm sharing, but I'm not.
So let me check.
Sorry, I'm very sorry for that.
Okay, we will share the slide from here. So
let me try. I can retry. Okay. Thank you very much.
Okay.
Okay, great. Okay. Just full screen.
Control L.
Okay, perfect. Thank you very much. Thank you very much for having me here, and thank you for the organizers and to the chair. I'm pleased to introduce you to our new work that we are conducting.
Paolo, I suggest you stay near to the microphone, otherwise the volume is up and down.
Okay, if you don't hear me well. Okay, so this is a work that we developed at the University of Pavia together with Ariana Agosto and Paolo Cerchiello. We are working specifically on cryptocurrencies and from different points of view. One is about measuring the risk, that basically multivariate risk that arises from cryptocurrency investments. The other one is to build portfolio strategies from the measures derived of the risk in order to try to grasp, let's say, some investment strategies that make money and at the same time is the risk is contained. And then here we try to predict basically bubble behavior of cryptocurrencies based on sentiment data. So basically we employ an econometric technique, which is very widely employed in the literature, is the augmented Dickey-Fuller test. But there is a nice, let's say, a nice formulation in which you can include covariate in order to basically test for the explosive behavior of an autoregressive time series of any kind, which in this case is Bitcoin, so that you can basically say when this is going to be a bubble, and we are now developing something to detect the burst better, because this is another issue. But I will tell you about, if we can go on with the slide, I'll tell you something more about the background. Basically, you know that, I don't have to tell you because you know a lot about cryptocurrencies. Now there are 13,600.
Paolo, again, I suggest you stay in front of
Sorry,
the microphone.
sorry. I sometimes forget. Thank you for. Okay, so basically there are around 13,600 cryptocurrencies, and as you know, many of them do at least one or two say very huge acceleration in the price. At least once in a life, these cryptocurrencies either don't jump or do jump very much. So this is a bit of what we observe in the real world. What we also know is that there are no fundamental values. So it's not like a company. You don't have a residual value of the asset. So basically, you can be with zero value at end if the cryptocurrencies, of course, go down. So basically, here you risk everything. No? It's sentiment-based also. The price, one may argue that it can be sentiment-based. Because of course, people invest into cryptocurrencies just because the neighbor or someone else told them that it might be a good investment. They are easily accessible nowadays. And especially among Generation Z and so on, you can imagine that there is a high sentiment component in the cryptocurrency investment. So basically, that is why the motivation why we try to measure the sentiment is already done also in the literature, but with some two different two measures, two alternative measures, which we can go also on with the slides. Basically, the two measures, let's say, are in this case sentiment provided by a company and Google queries. With this, we see we can already go on with this slide because it's more about the literature on urine truth tests. Don't want to go too much into detail, but I want to show you the approach which is a statistical approach in which you basically model the YT, which in our case is the cryptocurrency price, okay, in this way as an autoregressive process, of course, so it depends on its past value, and we measure how much it depends on its past values, okay, but also on some additional covariates that can be, of course, predictor of the behavior of the price. This, as you can imagine, is a very difficult task to do, to establish a predictor. We see in the literature, there is also a author of mine in Tübingen that did a paper, the cryptocurrency volatility can be predicted well from Google queries, for example, but the returns are difficult to predict. This is a bit because the queries are not polarized in the sense that they do increase both in periods in which the cryptocurrencies are going up and down. So one needs to detect when is going to be that period. So this is a bit of what we also observe. That's why we use also the sentiment that is from a company. In this methodology, what we need to test is this phi, the coefficient, which is basically related to the YT minus 1, because this is very important coefficient, which tells you whether the behavior of the time series is stationary, it has a unit root, or either it's explosive. So if this coefficient is greater than 1, based also, conditioned also on the behavior of the other covariates, then this means that you are detecting an explosive behavior of the time series. So the time series is running, okay? That is what we see. So if you can go on with the slide, basically we employ this. This is basically an extension of the augmented Dickey-Fuller test, the covariate augmented Dickey-Fuller test, which we develop in its backward superior, basically, version, in which this is a version, a very refined version of the test that can tell you when the price acceleration begins, and it's modified also to account for multiple bubble presences. So if there is a multiple bubble phenomenon within the sample, then these tests can detect. That's a bit of the rationale behind. So what we have in this analysis, as you might have understood, the aim is to detect this price acceleration a bit before, at least, because we need to exploit price acceleration. Wouldn't be much of interest just to timestamp, as many literature do, but I don't want to blame on them, but would be interesting to try at least to predict. So basically, we also see whether this is what we call a bubble discovery, but we also see what dominates crypto dynamics, whether it's the sentiment that is in the market or the volume. Of course, this is a measure of sentiment, can be questionable, but at least we try with this one at first. Now we are developing also with that. If you can go on, I show you some okay, this is the data. Now we tried with from 2019, just because the sentiment data was for that period. We've done for the Google Trends, of course, also the analysis for the first bubble. And with the three, I show you just the 3 cryptocurrencies, which are, of course, the most capitalized, but of course, we are also working with other data. The problem is that the sentiment that the company produces now is about 10 cryptocurrencies. The history is not very much. So that's why we are not comparing that much. Basically, this company, Brain, monitors about 2,000 sources of financial media and combines all of these sources through NLP. Basically, they give a score to all news, and this is a weighted score of all news weighted on basically on the importance of the journal and so on, to which they give -1 or +1 to the most positive or most negative. we compare this also with Google Queries. We employ also the same methodology with Google Queries. You know that with Google Trends, it's very nice because it gives you data that you can also, if you go lower frequency, you can go lower frequency, you can have also daily data and even more granular data on Google searches of terms. So whichever term you want to know, it provides you. So if you go on, I show you some briefly, really briefly, some this, you know, the cryptocurrency data. We can go on. We know this, there were bubbles. Okay, this is the brain sentiment data, which, as you see, they do not emulate the cryptocurrencies. And this is important because the covariate need to be stationary in order to be included in the model. This is an econometric specification that needs to be fulfilled in order to model soundly. So this is good. Then if we go the next slide, you see the Google Trends, which instead are very much more like crypto dynamics. Indeed, Ethereum is the one that is a bit more interesting because it has two spikes rather than one. Whether in the price, whereas in the price, yes, there are many spikes, of course, but the huge spike was one. So this is a bit interesting, in my view. Then if you go on, this is just some descriptive. This is already interesting because we measure basically the coefficient of the lagged covariate. So how much does how much is important the past value of the sentiment of each cryptocurrency or of the Google trend of each cryptocurrency, Google search, on the cryptocurrency dynamics. And you see that basically with the sentiment, when there is a price acceleration, which is basically the end of the sample, there are some interaction, the coefficient moves, whereas in the Google Trends, the coefficients remain a bit flat, they move before. So if you go to the next slide, we then see this, how this translates into our empirical analysis. Basically, here the plot shows you the price dynamics of the cryptocurrency. So you have Bitcoin, Ethereum, and Ripple. Then gives you the two test statistics that we use. So one is the test without the covariate, and which should give already some hints on the explosive behavior of the time series. The other one is the test including the covariate. In this case, so the red one. In this case is the sentiment index. On the plot above, you have this green signal, let's call it. This green signal is basically, this green area is the difference between these two tests. What we observe is that before the price acceleration, it's very interesting to note that with Bitcoin and with Ethereum, there is a trend reversal of the two statistics. So this means that the relationship between the covariate and the actual time series, which is Bitcoin prices, is changing through that time, at the point in time, which is a bit before the bubble explosion, if you see. So this is very interesting. Of course, it needs to be explored more because we need, of course, to set how long does it last. This is a weakness of these tests that do not tell you very much some confidence bounds, let's say, on when it's good also to move out. Okay, so this is a bit of the, already tell you some, because I need to be coherent, of course. It's not everything very nice. Then if we go to the next result, the next result is about Google queries, which instead sometimes are a bit different because we see with Bitcoin, they do not predict very well the price explosion, but with Ethereum, they do a bit well. When there is the trend reversal, indeed, and the trend reversal lasts very long, with Ethereum, we have that Ethereum price indeed goes up. With Ripple, it's quasi simultaneous, the explosion. So maybe the diversion. So you see, there are cryptocurrencies in which this works best, but needs to be addressed wise. The crypto market is very complicated, it's a jungle. I just read from a professor at the Stern University that just said, maybe the next cryptocurrency will be a nice cat and it will sell very much because it has a very nice face on it. So, and this is a bit of the story behind. So if you go to next slide, basically I summarize also the relationship between these two test statistics, and this graph tells you that for the two cryptocurrencies, and Ethereum is the specific one, this relationship changes a lot. So basically, this tells you that there is not very much, there is a misalignment in the sentiment and in the price of Bitcoin, and this causes also the estimation of the bubble different, whether you include the sentiment or not, whether you include the volume of the queries or not. But we have seen that it can be a relevant information, basically. We need to further test, if you can go to further, the last slide, maybe, I think it's last. Bene. Then, as you see, basically, this is a bit of the main takeout message. We need to statistically determine the burst of the bubble. This is what we aim to do, and there are already some papers doing it in the, let's say, more in the macro area also, but also in finance, and also in physics. So there are many different approaches. We would like to see whether this approach can be feasible also. We are testing, of course, with other cryptocurrencies, but since we have seen that sentiment might be a better predictor, we are trying to get information, because we have seen that basically the fact that the Google queries are not polarized gives you misleading, let's say, results in terms of the bubble occurrences, because maybe the price is not surging, but queries are. So the Google queries are more predictors of the high volatility. We can predict volatility. So maybe it would be also interesting to try to apply the same strategy on volatility modeling, and then maybe go and trade on derivatives. There are now emerging many derivatives on crypto, so many established already a lot. So if one goes on volatility, I think that this can work even better. So I thank you for the time, and glad to answer any question.
Okay, thank you, Paolo. Just one short comment, and then we'll see if there is time for a short question. The short comment is, I mean, it's also a question, why you choose this sentiment indicator, which is based on the financial news. Because, I mean, if I think about sentiment indicator, I can think about financial operator, and so maybe your choice is correct, but maybe also on Twitter for an informed operator, or on some Telegram channel for informed operator on this blockchain technology. So the comment is, my comment is also to try to use other sentiment indicator, and not only this one. And then maybe, I don't know if there is a...
I think that in Bloomberg there are two different kind of sentiment indicator. One's from the financial sector, and then investors, and then the other one for uninformed or less financially literate investors.
Yes, I thank you very much for this comment. Indeed, what we are doing, and now we are also working on some theses on those. Basically, we are using stock tweets. There's some sentiment, also stocks and so on. and the Twitter data, because we've seen that they're much more easy to grasp. But also, I think that both the comments, so before Daniele was mentioned, sorry, Telegram. Telegram is fundamental because we have seen it with cryptos and ICOs. You are right. You are totally right. You should write a dictionary for Telegram probably, but because it's a specific dictionary, but it's right. And also what Paola mentioned is very, very useful because on Bloomberg, I've just discovered, yes, actually, that there are those indexes that are very, very much useful and can be combined. They're also granular. So it's, I thank you very much. And I think this could improve very much because we can analyze also at a wider level.
Okay, thank you very much. So I think that we can move to the second and the last talk of the day. So Marco, are you online? Thank you, Paolo.
Thank you.
Yes, I am online.
Marco, are you online?
Yes.
Marco Patacca from Verona.
Can you hear me?
Yes, not so well, but I can hear you.
Yes, Can you hear me now? It's better?
Yes. We can hear you, but not see you, neither your screen.
Okay.
And you should also speak nearer to the microphone.
Yes.
Yes, I have the Microsoft very near to me.
Ok. Dobbiamo switchare noi da Paolo a Marco, è fatto automaticamente. Can you yes. Sorry.
Yes.
Can you share the screen? Yes.
Yes.
Okay.
Can you
great.
see my video?
Perfect. If you can switch on also the camera so you can see you. So we can see you.
Okay, now I have the camera open.
Yeah, but if you can speak closer to the microphone because we cannot hear you.
Understand why? Now it's better?
No, worst.
I don't understand why, because I have my laptop in front of me. I can try only one.
And
now it's better?
Marco can move the slide. Okay, Marco, please try to talk.
Do you hear me? Now it's better?
Yes, a little bit. Okay. So we can move to this last talk, which title is Common Dynamic Factors for Cryptocurrencies and Multiple Pair Trading Statistical Arbitrages. And I leave the floor to Marco Patacca for this last speech. Okay, the floor is yours, Marco.
Okay, good. Thank you. Good evening to everybody. First of all, I would like to thank the organizer of this conference for giving me the opportunity to present this talk. This is a joint work with Gianna Figata-Lamanca and Sergio Focardi. And the outline of the talk. We'll start with a brief introduction and motivation of the paper. I will show you the preliminary statistical analysis, and after that, I enter in the core of the paper with the dynamic factor model and the market neutral strategies. First of all, as you well know, the Bitcoin is the first decentralized digital currencies which provide a solution to the problem in a trust in a currency system. And opposite to traditional transactions, which are based only on financial intermediaries, this system relies only on the network, on fixed rule, and on cryptography. In the years following the birth of Bitcoin, many other cryptocurrencies have been created, and these other cryptocurrencies are generally called altcoins. Nowadays, there are more than 10,000 of altcoins in the cryptocurrencies world, but only a few of them have in some sense, market capitalization. In our paper, we focus on 4 cryptocurrencies, and we choose Bitcoin, Ethereum, Litecoin, and Monero. And we made this choice because we want to combine a double need. In fact, we want cryptocurrencies with a significant market capitalization, and at the same time, we want to have availability of at least 3 years of time series data. the main goals of the papers. As several cryptocurrencies are now available and can be traded on different exchanges, we want to explore the possibility of forming market-neutral strategies where gains and losses depends only on the relative behavior of the specific asset. In this paper, we consider the 4 cryptocurrencies, and we consider the data that start from January 2016 and to November 2019. I will go very fast with in this table. I will report the summary statistics of cryptocurrencies prices, and this picture shows the different price dynamics of the 4 cryptocurrencies. Even if the range of the price of the 4 cryptocurrencies is so different, if we in some sense rescale, we can see a possible co-movement in the cryptocurrencies time series. And in a companion paper, we analyze this type of co-movement among several cryptocurrencies, and we perform the analysis using the regime switching Markov model. And the results of this co-movement are that the existence of common regime the results show that exist of common regimes in the analyzed cryptocurrencies, and that at least 2 regimes are statistically significant for our for all model specification. This is in this picture we can see the main results of the other companion paper. In fact, we have in the column that we have the number of different regime switching model. We consider in the first column only 2 different regimes. In the center column, 3 regimes, and in the last column, 4 different regimes. And we have in red the regimes with highest volatility, and in blue the regimes of lowest volatility. And as you can see, in some sense, we have the regimes are common between the 4 cryptocurrencies during time. Okay, go ahead. And in this table, I report the results of augmented Dickey-Fuller test and KPSS test, only to say that the cryptocurrencies price are integrated of order 1, and of course the price differences are stationary. Furthermore, we apply the Johansen co-integration test, and we find that these 4 cryptocurrencies are co-integrated with 3 co-integrating vectors. These preliminary statistical analysis are useful to us to justify the choice of the model. In this paper, we use the dynamic factor model. Dynamic factor model are models that allow to specify the dynamics for factors and the processes themselves. And the general specification is the following. If we consider, for example, the P at time t that is equal to beta times ft plus epsilon, where f represents factors and can be modeled as an ARMA model. And we assume that we consider capital I different cryptocurrencies, and that we model their mutual relationship through a dynamic factor model. In fact, we consider that general price of crypto I at time t that is equal to alpha I plus the dynamic factor plus epsilon. In this way, the presence of the 3 co-integrating vectors imply that our 4 cryptocurrencies share one common integrated factor. And in order to detect the total number of common factors, we follow these 3 steps. We estimate the model that I showed you before with just only F1. We compute the covariance matrix of the residuals and the corresponding eigenvalues. And since the eigenvalues are the following, we decide to add a second relevant factor. And based on the previous analysis, at the end, we assume that K for us, in our case, we have K equal to 2, and we consider the final model specification with the following specification. We have that P crypto I at time T that is equal to alpha I plus beta 1 F1 plus beta 2 times F2 plus epsilon, where both F1 and F2 are autoregressive order 1 factor. But this formulation, we expect that by our co-integration analysis, we expect that lambda 1 is equal to 1 because we have an integrated, F1 is an integrated factor. These are the parameter estimates of our proposal model in our model. And as you can see, we have that the first factor, for example, beta 1, essentially emulates the dynamics of Bitcoin, while the second factor is strongly related to the to Ethereum cryptocurrencies. The integrated factor is, in some sense, an unforecastable random walk, while the stationary factor is a forecastable process. Our goal is that we want to create a long-short portfolio that does not depend on the first factor, but only on the second one. And since we are interested in investment strategies, we decide to define P star as the ratio between the price of crypto and the beta 1. That beta 1, remember that the beta 1 is the coefficient of the integrated factor. After that, we find the difference between two different cryptocurrencies in the following way. In this way, our difference, the IK, depends only on the second stationary factor. And following this model, we try to develop in a market neutral strategies. In fact, we assume that we are at time tau, and that the price of our basket of cryptocurrencies is described by a two-factor dynamic model. And the one-day ahead forecasted prices is given by pi-et, that is equal to expected value at time tau of pi into plus 1. And following this way, we obtain that one day ahead forecasted difference for any pair of cryptocurrencies is given by the d at ik into plus 1. And of course, this difference depends only on the second factor. If this difference is strictly positive, a future revenue can be obtained by applying a long-short investment in the pair of high K of cryptocurrencies. And we try to maximize our revenue by investing on several pair of cryptocurrencies which display a non-negative forecasted difference. To do this, we denote with p hat high the crypto in ordinal statistic in decreasing order of the scale forecasted prices, and our multiple pair trading strategies essentially consist of short position on the first half of cryptocurrencies that are the cryptocurrencies with higher forecasted prices, and go long position in the second half of cryptocurrencies that are the cryptocurrencies with lower forecasted prices. We denote with Vto the value at time tau of the above investment portfolio, and the one-day ahead expected value of the strategies is given by G into plus 1, that is equal to the expected value at time tau of V into plus 1. And we compute this value, and we compare the forecasted gain in tau plus 1 with the corresponding gain time t, and we apply the following strategies. We go long if the gain, expected gain, is greater than v tau plus c sigma tau. We go short if the gain in tau plus 1 is less than v tau minus sigma c sigma tau, and we not apply any type of trade if the expected gain is between b minus c sigma and b plus c sigma, where we choose, where c in this case is an arbitrary chosen constant, and sigma tau is the standard deviation of the trading position value corresponding to the basket price time series. And every long-short portfolio strategies will be liquidated at the following day. If this above strategy is repeated for n consecutive day, then the expected cumulative gain is given by capital G in tau plus m, that is given by this formulation. We apply in our empirical analysis, we apply these proposed market neutral strategies strategy to the daily price of Bitcoin, Ethereum, and Monero from 2018 for a total of 334 days. And each day we estimate the dynamic factor model on a moving window daily observation available for the previous 3 years day. And once the parameters are estimated on each moving window, we forecast the prices and we compute the 1 day ahead forecasted difference, and we apply our proposed market neutral strategies. In this table, I report the main results of our strategies. In the panel A, we have the results for the cumulative gain, while in the panel B, we have the net cumulative gain. The net cumulative gain take so into account the transaction, the inclusion of the transaction fee. As we expect, if we don't consider the transaction cost, we obtain the best results in terms of results, considering the constant C equal to 0, while when we include also the transaction cost, transaction fee, we obtain the best results, increasing a little bit this constant, because the increase of C let us to avoid to apply our strategies to the trade when in some sense the forecasted gain is not so different the real position. And in this plot we have the results for the cumulative gain, both with the inclusion of transaction and without the transaction fee. And concluding, in our paper, we argue that it's possible to form market neutral strategies in the cryptocurrencies world, where gains and losses depends only on the relative behavior of assets. And we use the technique of dynamic factor analysis to disentangle the integrated and stationary factor. And we propose a basic market neutral strategies to create a long-short portfolio that does not depend on the forecastable factor. And at the end, we apply our strategies to empirical data, and we obtain good results in terms of gain. Thank you very much for your attention.
Thank you, Marco. Is there any question from the floor, from the audience? Otherwise, I have a short question. I would like to ask you if you have tried also to apply your algorithm with 3 assets, and if how was the performance, and on the contrary, if you think that using 5 or 6 cryptocurrency can improve the performance of your strategy.
Yes, thank you for the question. Yes, now we try our algorithm only considering these 4 cryptocurrencies. I think that increasing the number of cryptocurrencies, we can obtain also best performance, because we can choose to trade only on the difference that are higher on a chosen threshold, and this can give us the opportunity to have, in some sense, much more diversification. I try that can increase the results in terms of gain, increasing the number of.
Okay, thank you. So I leave the floor to the organizer for closing this first day.
Yeah, thank you very much to everybody. Of course, to all the presenters, but also to the attendants, both the one in person and the one from remote. And again, thanks to our sponsor, Deloitte, CheckSig, and Elidata. And of course, to the organizer, University of Milano Bicocca, that is the host of the conference, the DG, JRC, Joint Research Center of the European Commission, and Digital Gold Institute. Tomorrow we will start at 3 p.m. again, and we will have a keynote speech from Ricardo Perez Marco, and then we will go through 3 different sessions on investment and trading, fungible and non-fungible tokens, and legal and regulatory sessions, and we will also have the sponsor speech from Deloitte. So thank you everybody, and see you tomorrow, and again, have a good day, have a good evening, and have a good dinner. Bye.